I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Happy Friday, everyone. Stock futures, they are mixed this morning, and here's why. The S&P 500 and NASDAQ futures looking to rebound from Thursday's losses. Plus, you've got Dow futures in the red after the index dropped more than 500 points Thursday. Let's get to it with the three things that you need to know this Friday morning. Yahoo Finance's Jared Blickery, Madison Mills, and Rick Newman have more.
CrowdStrike CEO George Kurtz is apologizing for global tech disruptions, telling multiple media outlets that he is deeply sorry for the impact to customers, traveling, and anyone affected. Technical disruptions linked to CrowdStrike spread around the world Friday, affecting airlines, banks, and retailers, among other businesses. Now, Kurtz says the company identified the issue, a defect found in a single content upgrade for Windows hosts. He also claims this is not a cybersecurity incident or a cyber attack. The issue has been identified, isolated, and a fix has been deployed. Microsoft Azure says they are aware of an issue impacting virtual machines running Windows Client and Windows Server running the CrowdStrike Falcon agent. They've had reports of successful recovery from some customers. Major U.S. airlines, including Delta, United, and American, initially grounded flights, but they have resumed some, but warn of continued disruption. Financial and retail organizations have reported seeing blue screen errors. Shares of CrowdStrike and Microsoft are lower this morning.
And Netflix kicking off big tech earnings after the bell on Thursday. The streaming giant's revenue outlook missed Wall Street's expectations for the current quarter, initially sending the stock lower. It's recovering now, up nearly 0.8%, and this comes after investors digested another 8 million plus subscriber gain and saw ad-supported memberships growing 34% quarter over quarter. In another bid to boost the ad tier, the company said it would phase out its basic plan membership in the U.S. and France after removing that sign-up option in the UK and Canada last year. The stock is up more than 30% since the start of 2024.
And former President Donald Trump accepted the GOP nomination for president Thursday night at the Republican National Convention. Trump spoke for 90 minutes, hitting on a wide range of topics, touting his performance in his first term and making a big promise on inflation. Let's listen.
We have an inflation crisis that is making life unaffordable, ravaging the incomes of working and low-income families, and just simply crushing our people like never before. I will end the devastating inflation crisis immediately, bring down interest rates.
Our top story this morning, the global tech outages linked to CrowdStrike, rippling through multiple business sectors. We've got team coverage of the outage and the incident here. Yahoo Finance's Jared Blickery and Madison Mills are here with more. Hey, Jared.
Yeah, let's focus on the companies involved in these tech disruptions. First, CrowdStrike shares, they are plummeting off of the back of this tech disruption. CrowdStrike CEO George Kurtz, he has apologized to customers, travelers, anyone affected. He's saying that the cause of the incident was a defect found in a single content update for a Windows host. In a statement, Kurtz wrote that the issue has been identified, isolated, and that a fix has been deployed. Now, on Microsoft's side, shares are down too. The company posted to their Azure status page that they are aware of an issue impacting virtual machines running Windows Client and Windows Server that are running the CrowdStrike Falcon agent. Now, this may encounter a bug check and get stuck in a restarting state. So they've also said that they received successful recovery reports from some customers. Now, taking a look at some of the other stocks moving on the news, got to take a look at Palo Alto and SentinelOne, both competitors of CrowdStrike. They are rising.
And broadening this out a little bit, we are seeing disruptions reverberating across several sectors. I want to talk specifically about banks and retailers. So I'm going to kick it off with the big banks, starting with JP Morgan, speaking with our banks reporter David Hollerath, declining to comment on the record. But on background, he did have sources confirming that there were outages that made it difficult for JP Morgan employees to log on. And this is impacting the company globally. We know that Hong Kong staffers in particular already went home for the day. And this is particularly prescient at some of these firms that have really started to rely on private cloud software seeing these challenges. We also know that Deutsche Bank and S&P Global also facing some blue screen of death situations at their offices, which is impacting their ability to move forward with the workday. We're hearing from some hedge funds unable to process certain trades across the world. This is happening in Hong Kong, South Korea, and Singapore. I do want to move on, though, to some of the retailers. I just got a note in from Starbucks, particularly on their Starbucks Care X platform, posting about some individuals experiencing an inability to order ahead. We are out to Starbucks to confirm that. Seeing some posts across X as well from individual stores saying that they are struggling to keep up operations today, specifically with regards to that order ahead option. We also know that McDonald's had to close 30% of its stores in Japan today following this outage. We will see what happens with these retailers throughout the course of the day in terms of their operations and the degree to which any of these disruptions could impact profits for the day moving forward, guys.
All right, and we are also hearing of some of these airline disruptions. I was traveling back last night, fortunately missed some of the blue screen of death that you were talking about, Maddie, in my own experience. However, that doesn't take away from what we're seeing here rattling across and through the industry this morning. I've got updates for Delta, American Air, and United Airlines. I'll start off with Delta, as they have resumed some flight departures after they acknowledged this vendor technology issue impacting several airlines, not just them, and businesses around the world. And it necessitated a pause, a ground stop, and delays early this morning here. Delta's global flight schedule this morning was addressing this. You also have an update that came through from United Airlines saying that the third-party outage was impacting computer systems, including United, many other organizations worldwide. But some of those flights also resuming there. And then just to round out for the big three major airlines, let's go to American Airlines as well here. Earlier this morning, they identified the technical issue, and they said as of 5 a.m., they had been able to safely reestablish their operation. And so we're going to see even more of these airline operators begin to gradually resume flights as they bring operations back to some normalcy here this morning, Sean.
Yeah, exactly. We're seeing some systems come back online, but I think the question that everyone is asking right now is so many people arrive at their desks on the East Coast and then, of course, over the next few hours on the West Coast is exactly how far and why this outage has spread, what ultimately it means for the day-to-day, not only today, but also looking out over the next several days, as there's lots of questions as to how long it's going to take until we return to quote-unquote normal operations. We have been digging into the impact for, and it could really impact you at home. We talked a lot about travel. We talked about banks, the retailers, even a name like UPS putting out a statement here earlier this morning saying that they do see the potential for delivery delays from the global tech outage. They did, though, in a service alert here on UPS's website, talking about the potential for the delays, but they did say that right now the network is operating and delivering in all areas. So here we are, just about 23 minutes ahead of the opening bell. Lots of questions about whether or not the exchanges here in the U.S. are going to be impacted. We got statements from both the New York Stock Exchange and the NASDAQ. A spokesperson at the New York Stock Exchange telling Yahoo Finance this morning that the NYSE markets are fully operational and we expect a normal open this morning. From the NASDAQ putting out a statement saying that our European markets and U.S. pre-markets are operating normally. We expect our U.S. markets to open normally. And we bring this up because there were some hiccups when you take a look at what happened on a global perspective. Short while ago, you had the London Stock Exchange saying that their RNS service has now been restored. It had some hiccups there shortly after the open and is now operating normally. So again, this is a story we will continue to track here, given the massive fallout and lots of questions about what exactly caused it, how long this is going to be an issue, and exactly the impact that it's going to have for you there at home. Let's talk a little bit more about the outages. For that, we want to bring in Simo Kohonen. He is Diffused, a cyber deception researcher and founder, and Diffused is a Finland-based network security company. Simo, it's great to have you, and thanks so much for hopping on with us here at the top of the hour. I think first, just take a step back. Tell our viewers what exactly went wrong and what's happening right now.
Well, yeah. So one of the biggest cybersecurity vendors in the world seemed to have pushed out a faulty update, which essentially, when it was installed, it broke everything. And that's why you're seeing so many companies out there just completely knocked down to their knees. We're speaking of a vendor here, CrowdStrike, who many hold to be the top #1 cybersecurity company in the world. They have about 70 of the 100 Fortune 100 companies as customers. I think over 250 of the Fortune 500. So the scale they have in their customer base is huge, and that's probably the biggest driver of the issue at hand right now.
What type of quality assurance tests do updates like this go through typically before they even get pushed? Because it seems like this is something that maybe could have been avoided, just to make sure that there was, some compatibility with all of the different systems that are intertwined around what CrowdStrike offers here.
Yeah, I mean, things happen, right? The nature of the specific component that seemed to have contained the faulty bits to it is something that sits in a very low level of the computer systems. And so in these areas, like having one byte in the wrong direction can crash things. I'm extremely sure CrowdStrike has some very robust quality control, testing routines, all of that. Sometimes snafus like this can happen even regardless of whether they are running best practice.
Simo, how long does it take to correct something like this?
It depends a bit. I know it's a bit of a lame answer, but it depends very much on where the agent is running. So if the user of the agent can easily run the update routine or revert to the previous version, which is a big if, then it should be fairly straightforward. I know some CrowdStrike customers hadn't actually received the update yet, so some dodged the bullet completely. If it happens that they have to use the manual routine, which was a fallback provided by CrowdStrike for the situation, again, depending on scale, it might take very long time, between 5 to 10 minutes per system to actually restart things. And if you think about the scale of computer systems globally, if you have to run this type of routine for a set of computers of, in the scale of thousands, then it can easily take quite a long time.
CrowdStrike CEO George Kurtz, who has spoken with Yahoo Finance on multiple occasions before, making some media rounds this morning, apologizing for this mistake and for this outage. What type of kind of longer term impact do outages like this have in terms of new customers, net new customers that companies look to bring on to use their services like CrowdStrike is dependent on for their continued growth?
Well, I'm very sure a lot of CrowdStrike competitors will jump on the occasion and jump on the opportunity to take advantage of it. But from a very technical perspective, if you want to run this type of software, which has a lot of capabilities, with great power comes great responsibility. It will, regardless of the vendor, it will require quite low-level privileges to run. I think CrowdStrike will have a lot of conversations with their current customers and their future customers about what they're doing differently. I think they might take a short-term hit from it, but they're still an extremely reputable vendor. I'm very skeptical whether it'll turn into a long-term bad thing for them, essentially.
But real quick, we only have about 30 seconds here, but is something like this almost unavoidable, or is there a way to prevent something like this from happening again?
Well, on a long enough time scale, you could say that it's unavoidable. Mistakes happen, and even though this looks like a basic one, sometimes we see things like this. I'm sure we won't see another one in the next 10 years.
Simo, thanks so much for taking the time to join us here this morning. A diffuse cyber deception researcher and founder. Appreciate the time.
Thank you for having me.
We're tracking shares of Netflix as well this morning. NFLX feeling some pressure after the streaming giant's Q3 revenue guidance fell short of expectations. Shares, though, are up by about 1%. The stock originally dropped 6%, though, on Thursday. The stock is regaining some of those losses, as I mentioned, as investors digested another 8 million plus subscriber gain driven by a strong content slate and benefited from its top line initiatives like its crackdown on password sharing. For more on this, we're joined by John Blackledge, who is the TD Cowen Managing Director and Senior Equity Research Analyst here. Great to have you here with us. So let's talk a little bit about these results. I mean, in terms of where it stacks up against some of your own expectations and what this means for what many have looked at as the best in class, at least on margin performance. Does this further solidify investors' expectations, or is there something else at play here?
Yeah, no, it was definitely a solid quarter, and the guide was good. Like you mentioned, for 2Q, they added 8 million net member adds. That was a record for 2Q outside of 2Q 20, the first year of COVID, and it was above our and consensus estimates of about 5 million. It was kind of within investor expectations. And then, the 2Q revenue was mostly in line, but like you said, they beat on margins again and earnings. And for the full year for 2024, they raised their revenue guide a little bit, and then they raised their op margin guide for the third time since they set it to 26% from 25%. They're looking for essentially 5 points of margin expansion this year, which is great. All in, we kind of kept our forecast mostly in line, and our price target remains at 775 and maintained by there. We view, there is a good amount of upside from here, despite the stock being up quite a bit this year.
John, what does that upside look like, do you think?
The upside to 770, like what drives the upside?
Yeah, exactly. What's going to be the catalyst here to keep that momentum going in that direction?
Yeah, I mean, it's so global streaming leader, right? Management said last night, we just talked about the big margin expansion this year. They expect margins to continue to rise next year and going forward. Free cash flow rising. Stocks trading at about 27 times earnings. We think some of those factors that I just mentioned could drive multiple expansion. And what I'd also point out is on the ad tier, I thought they were pretty bullish on the long term. And also kind of on the near term, right? They expect the ad tier to reach critical scale by next year in all 12 of the AVOD markets. In other words, they're going to get to a certain number of members that are attractive for big brand advertisers in those markets. And to boost those goals, they're retiring the basic tier in US and France, like now, this quarter, like they did in UK and Canada last quarter. And so another driver, certainly in the coming years, is the ad tier. We have ad tier members over 30 million this year, and then rising to over 40 million next year, and kind of growing from there. And just lastly, somewhat lastly on the ad tier, management has said, like, hey, it's a good entry point for consumers in those markets. So it should be a tailwind to member growth in the coming years.
Where would you like to see Netflix spend right now? Is it on sports rights? Is it on more content that they produce, or is it on licensing?
Yeah, great question. So they told us, right, and they confirmed that they're going to spend about $17 billion in cash content spend this year. That's up from about $13 billion-ish last year. And what we're seeing now, the next leg of content evolution for the company is live events, right? And I've covered the stock for a really long time, and if we go back to when they started streaming and they started advancing in making their own content. They first started doing episodic, and then their goal was to launch 5 or 6 episodic shows across different genres. And then it was to launch a film a week. And then it's making content in 40 countries. And now the next leg of the content is live events, to your point. They're going to stream globally 2 NFL games in the fourth quarter. They have Tyson fight coming up. They had the Brady roast, and so but it's so early. It's just starting, and so this is another leg for them of content, which should be helpful for user engagement.
The infamously censored Brady roast, John. My goodness. I mean, I just wanted to hear some people get booed. But anyway, John Blackledge, TD Cowen Managing Director and Senior Equity Research Analyst. Thanks so much for taking the time.
Thank you.
Certainly. Former President Trump officially accepting his nomination at the final night of the Republican National Convention and spoke about his plans for inflation and the economy should he take office.
We have an inflation crisis that is making life unaffordable, ravaging the incomes of working and low-income families, and just simply crushing our people like never before. I will end the devastating inflation crisis immediately, bring down interest rates, and lower the cost of energy. We will drill, baby, drill.
Introduced without comment, Yahoo Finance's Rick Newman joins us with the details. Hey, Rick.
Hey, guys. We taped a new podcast this morning. Ben, Rochelle, and I, our new capital gains podcast, Capital with an O. And Ben down in D.C., he said Trump actually gave two speeches. He broke it down. The first was a 19-minute speech. The second was a 73-minute speech. The 19-minute speech was the one that Trump had been telling us where he was going to talk about uniting the country. There was a dramatic retelling of the assassination attempt last Saturday. And that was interesting because that was Trump in a different way. And then the other 73, the other speech, the 73-minute one, was basically Trump's campaign speech. Although he was a little more monotone than usual. It was monotone Trump rather than outraged Trump. But he basically went through all the things he felt he did so great during his first term and all the things that are wrong with Biden. And he decided he wasn't really going to unify the country after all. He referred to crazy Nancy Pelosi. He trashed Biden. He said he wasn't going to mention Biden's name, but he did twice, and he couldn't resist himself. And there were all the lies and exaggerations we've gotten familiar with. The Washington Post had a nice breakdown this morning. They detailed 24 lies and exaggerations Trump told about the economy, about inflation, and things like that. So we are back. We're kind of back to where we were before the assassination attempt, I think. And the big story now is going to be, what does Joe Biden do? Does he pull out? And a lot of people think he is going to pull out possibly by this weekend.
Yeah, what's the latest that we're hearing on that there, Rick?
His candidacy is becoming untenable. And I think there are four prominent Democrats who are talking with Biden about this. It's Hakeem Jeffries, the minority leader in the House, Chuck Schumer, Nancy Pelosi, and Barack Obama. Those are the big four. I don't think we're going to hear any of them come out and publicly break with Biden and say he needs to go. I think they are very clearly telling him privately that he needs to go. And Nancy Pelosi previewed this last week. I mean, she said on MSNBC, yeah, I'm waiting to hear what Biden decides about his presidential campaign. Biden, of course, has been saying all along, there's no decision to make. I've already made it. I'm running. But Nancy Pelosi said, yeah, I'm interested to hear what he decides in coming days. And I think that was a signal right there that the sort of inside machinery of the Democratic Party is working hard to get Biden to withdraw. And if he doesn't withdraw, it's hard to see how he could win, because now the Democrats are almost as much against Biden as the Republicans are.
Donor funding's dried up, essentially.
Yeah. I mean, it's not a civil war because it's not infighting. It's basically trying to take the keys from Grandpa. It seems likely that he is going to withdraw by this weekend.
All right, Rick, we will continue to track all these developments. Great stuff. Thanks so much for hopping on
guys.
with us. And congratulations on the news pot.
Yeah, everybody watch. It's going to air later today. Capital Gains.
And listen.
Gains, and we're looking forward to listening to that. All right, let's continue with this conversation. Former President Trump taking the opportunity during his speech at the RNC to criticize the Biden administration.
If you took the 10 worst presidents in the history of the United States, think of it, the 10 worst, added them up, they will not have done the damage that Biden has done. Only going to use the term once. Biden. I'm not going to use the name anymore, just one time. The damage that he's done to this country is unthinkable.
This comes as the calls within the Democratic Party grow louder for President Biden to step aside in the 2024 presidential race. A new poll out from AP finding that 65% of Democrats say that President Biden should withdraw from the race in favor of someone else. Ed Mills, Raymond James, a Washington policy analyst and managing director, joins us now. Ed, it's great to talk to you. So let's start now with where things stand on the Democratic side. We've heard the reports. We've seen the reports over the last several days, more and more Democrats coming out and calling, or at least talking privately maybe, for President Biden to step aside in the race. From your perspective, is it just more of a question of when and not if at this point?
Shauna, I still think that we are on a collision course. It's very clear that congressional Democrats want him to step aside, but it's also very clear that the Biden team and Biden himself wants to stay in this race. The COVID diagnosis and the fact that he's home off the campaign trail only restarted this. I do think that, we're looking at a situation where Biden has the delegates, and if he wants to be the nominee, he still has the ability to be the nominee unless delegates decide to change the rules, and then we have a really messy situation on our hands. Compounding that is the fact that the Democrats have chosen a date after the ballot deadline in Ohio, pushing for an online convention. So one of the questions is, do we even get to Chicago and have the opportunity to have an open convention? It's a real freak out right now in terms of Democrats who are seeking to keep their power in Congress. They look at this campaign as something that could drag down the entire ticket, cost them an opportunity to get a majority in the House, and cost them the opportunity to maintain the majority in the Senate. That's why we're seeing this big push by congressional Democrats trying to push him aside. But what Biden says is this is the same crew that pushed him out in 2016, which gave us the presidency of Donald Trump in the first place. That's the tension.
How much of this also comes back to an incapability to market the messaging, or at least continue to put front and center the messaging of what the election is actually about from the Democratic side, either to younger voters who are going to be relied on to essentially show up and have those large voter turnouts that typically favor Democrats, or even the large donors out there, because that's what a lot of people actually want to hear about as well here, especially if on the other side you're just continuing to hear perpetuance of lies, typically, that come through. So how much of this comes back to their ability to actually get the messaging through?
Yeah, so Brad, as it relates to turnout, as it relates to Democrats and demographics, there are some real concerns here. You look at traditional voting blocks that are in favor of Democrats, and there's real weakness among Hispanic voters, among Black voters. You mentioned younger voters. One area of strength that I don't think gets enough attention are seniors. They're with the president in a way that Democrats usually do not see, partly because of all the conversation about his age. If you push him out, are you going to get enough younger voters to offset what you might lose in older voters? And if you have to bet which group shows up, I think a lot of pollsters will tell you those older voters are much more likely to come out. As it relates to the conversation, I think the Biden campaign knows that if this is a referendum on Joe Biden loses, because he's underwater in his favorability ratings, right track, wrong track. The country, only about 23% of the country thinks that we're on the right track. They have to move this to be a referendum on Donald Trump. And unfortunately for them, is they're not able to do this. If anything, Trump has gained steam as Biden has become weaker in this. So I think there is a desire to reset that narrative. If there is another candidate, can that candidate make it a conversation about Trump and a conversation about how unfavorable he has been in his favorable versus unfavorable ratings, having that shot on goal, and maybe even trying to keep those losses in Congress much more minimized than what it looks like it would be today.
Ed, for investors out there who are watching this at home, closely following the headlines with the reports here that President Biden could drop out of the race as early as this weekend, what do they need to prepare for in terms of the market reaction? What are we likely to see?
Shauna, this morning at Raymond James, we put out a note that highlighted how much of a Trump trade has been put on. Earlier this week, we did a call with investors. 91% of investors in a poll said they expected Trump to win, either with a sweep or with a divided Congress. So that tells me, the Trump trade has been on quite aggressively. The assassination attempt last week only made people feel it's much more likely for this to happen. So recognizing the humanity and kind of recognizing what our job is, what I would say is, to the extent that there was a change in the Democratic ticket, I could see a stalling out in the momentum there. And that's been the Russell 2000, key regulated areas like energy, healthcare, financials. I don't expect a broader market situation. What we told clients at Raymond James is that we would not immediately change our estimates, that we still think this is Trump's race to lose. We'd have to see who the candidate is. We'd have to see who the vice president is. We'd have to see how they perform before we could make those assessments. There is a chance that a new candidate has some downside risk compared to where Biden is polling right now. It looks like Trump's winning, but it's still pretty close. But there's also some upside. So if there is that upside, if there is a sense that Democrats could capture the White House, maybe have a Democratic sweep, that's where the conversations on taxes come in and are huge issues for the market. if we're going to raise corporate taxes, if we're going to not extend out the individual taxes, that impacts consumer sentiment, that impacts consumer spending, that impacts earnings for every country out there.
Ed, we got to end things there. We certainly do appreciate you breaking down the Trump trade and as well your analysis that you put out in the note this morning. Ed Mills, Raymond James, Washington policy analyst and managing director, as we're ticking closer to the opening bell. Thanks, Ed. That is the opening bell here in the U.S. Taking a look at the NYSE, the New York Stock Exchange. You're seeing Pearl Diver Credit Company, PDCC. You down with PDCC? Yeah, we'll workshop it. Anyway, you know me. There we've got to look at the NASDAQ, and you've got Glace ringing the opening bell there. Maybe glacé for the French-speaking folks out there. I'm not sure, but anyway, taking a look. Is that a play, or is it like is it a cupcake company? I'm not sure. Great group of folks though up there. All right, we got the opening bell here. And taking a look at the major averages, we're down across the board. S&P 500, that is flat, just barely to the downside. We'll see if that gets some green on there. It looks like it's moving that direction. And there we go, summited into the chat. The NASDAQ, though, still in the red. That's down by about 0.2%. And the Dow, you're seeing that lower by about the same on a percentage basis.
I got an answer for you.
What's that? What is
in
Glace?
honor of National Ice Cream Day, which I guess is
That's
today. That's Glace. Yeah, and Glace is the viral ice cream and treat shop. So it's visiting the NASDAQ, ringing the opening bell in celebration of that.
Is our ice cream?
Where's our ice? I know. If we knew, we could have been celebrating with Sundays here at the Open. You know, there's always next year. We just gotta mark it on.
I took a flight back to make it to the show today. No ice cream?
I know, no ice cream. We're not happy. All right, but let's take a look at where things are standing here this morning at the Open. A minute into the trading day. Lots of questions about what exactly this rotation that we have seen out of some of those mega cap tech names, whether or not that's here to stay. Jared Blickery has a closer look at some of that movement that we're seeing at the big board. Jared.
That's right. What a week. We got sector rotation on. We got the CrowdStrike outage, but let's take a look at the Dow first. This is an index that came alive. It's been hitting record highs, and you can see it's still up 1.4% over the last 5 days this week, despite that big drop yesterday. Now, you compare that with the NASDAQ, which is down 3%. In fact, the last 2 days, this performance in here to the downside, that was the worst in over a year. So it really has been a tale of two different markets. And finally, the mega caps have been slumping over the last 2 weeks or so as the soldiers, the 493, the rest of the market has been catching up. Also want to point out small caps here up 2% as well. They've been on fire recently. And one of the dynamics I've been tracking over the last 2 days is the US dollar index. That has been heading higher. I think that was in part giving a part of the problem yesterday when we were seeing those headwinds in the market, and we saw that nasty drop off in tech shares. Now, let me take a look at the sector action here. And here we have healthcare, XLV in the forefront. That's up 0.9%. And once again, it is tech trading to the downside, down about 0.9%. And let's take a look at the 5-day totals here just to see what's going on. Really been a story about value and cyclicals this week. Energy and financials grabbing the top spot. Then you got staples and real estate in there. So kind of a mix-up week there. Tech really got hit this week, not thanks to CrowdStrike today. That was probably the cherry on the cake there. So tech down 5% this week, guys.
All right, Jared, thanks so much. Teeing up the rest of today's activity for us and a little bit of a look back on what's gotten us to this point so far. We're just getting started here on the morning brief. Coming up, SunPower shares sinking after halting solar installs and shipments. We've got some top trending tickers coming up. And small caps also on the rise so far this year. We'll speak with one strategist who says the rally will continue. That's later this hour. Plus, stay tuned. 10 a.m. hour, Catalyst. We're going to speak with a Tesla shareholder on what a Trump presidency could mean for EVs. All this and more. You're watching Yahoo Finance.
The NASDAQ, I guess, pretty much unchanged here this morning, slightly to the downside, coming off its worst two-day slump that we've seen since October of 2023. We've seen this rotation out of larger cap tech names, those that have been leading the rally over the last several months, and into names that haven't necessarily participated here. All of this being driven by hopes of a rate cut. So here to discuss what exactly that means and what we could expect going forward, we want to bring in Ryan Dietrich. He's Carson Group's Chief Market Strategist. Ryan, it's great to talk to you. So first, let's just get your reaction to what has played out here over the last couple of trading days. Certainly, we have seen this rotation out of those larger cap tech names. Is that a trade that you think is here to stay?
Well, first off, thanks for having me. And I agree. We should all be eating ice cream right now to celebrate National Ice Cream
Thank you,
Day.
Ryan.
I can't believe we missed that memo. We have to yell at somebody.
Thank you.
All right. And nice Naughty by Nature reference earlier, Brad. I got that.
Got you covered.
Anyway, let's get into it here. So I came on with you guys 3 weeks ago. I was in person in New York, and we talked about the idea the second half of this year, inflation should get better. We're probably going to see some rate cuts. People didn't really believe that 3-4 weeks ago necessarily. Now we've got the better inflation data with the CPI and honestly the PCE. You put all this together, do we expect small caps to do this, right, the past week and a half? No. But to see some, flows out of large cap tech and into the smaller names, into some cyclicals, that is absolutely how we've expected it. A week and a half ago, we released our mid-year outlook at Carson Group, and we wrote that. We said that. Like the day after it came out, the Russell 2 went up 1%, 5 days in a row. Kind of random, but nonetheless, I don't think this is shocking. I think we expected this type of move, and honestly, guys, we think it's going to continue. Doesn't mean we hate tech. We're more neutral tech, but we really think these other underloved, underappreciated, and underowned areas are probably going to be pretty good the second half of this year.
Ryan, and forgive me, I was out in Orville, Ohio, the mecca of spreads, jams, jellies, and Uncrustables for the past couple days. But I did see a notification come across on my phone about the levels to which we were seeing slippage in Nvidia, which was what a lot of people we're tracking as part of this broader tech slippage. And we're essentially now back to some levels where after insiders were, doing some profit taking, we're back to some of those markers. Is there more slippage ahead that you believe? And if so, where does that rotation then go into from some of that profit taking?
Yeah, great question there. And we do think there could be a little more slippage. Nvidia, I can't really give recommendations on individual stock, but we know these large companies are making a lot of money. So this is not a 1999, 2000 moment in our opinion. At the same time, when you see the fact that, listen, I think it's like 2.7 cuts are expected from the Fed. We think it's more like 3. We think inflation is going to keep getting better. What does that mean? Well, if yields go a little bit lower, we know that it's all about the debt financing when it comes to small caps because large caps have a lot of that debt finance. So keep this simple. Yields go lower, Fed cuts. We still think small caps, mid caps, but also we like industrials and financials here. And financials have been a little rocky. Some of those broker dealers had some rough news lately, but still we think financials and overall industrials is we don't have a recession. Just look at this week, right? This week, while you're eating a good jelly. I'm from Ohio, so I know all about the jelly in Ohio there. But when you think about it, just this week, what have we seen? Retail sales came in better than expected. The control group, without getting too in the weeds here, was really, really solid. Then industrial production saying, listen, manufacturing's doing just fine also. So we do not see a recession. We see those rate cuts. Industrials, financials, small and mid caps are some areas we're overweight in the money that we run for our Carson partners.
Ryan, we've seen some moves here driven by the latest political developments, and I know you have looked at a lot of the historical data, just what exactly the market movements tend to look like leading up to and after the election. I'm curious, just given the current landscape right now, all the uncertainty, now the focus, of course, is on whether or not President Biden is going to drop out of the race. How do you think, or how are you at all making any adjustments to your positioning in preparation for that?
We're not making any changes to our views on just what might happen in Washington. Let's be clear. But I do want to point out this. This was the best first 6 months to an election year since 1976. Normally, the first half of election years aren't all that great. Clearly, this year has been a little different. But what have we also seen? Just for the listeners to know this, August is usually not that great of a month. August is usually pretty darn strong in an election year. So just kind of have that in the back of your head. But we're looking at it like this. What we're telling our Carson advisors and our clients is this. September, October of an election year is usually not that good. The last couple elections, it's been pretty scary. We've had some pullbacks and volatility, pre-election jitters. After the rally that we've had, we think it'd be perfectly normal to see that once again. Don't forget, a year ago right now, well, almost right now, I think it was July 31st to October 27th, we had a 10% correction in the middle of a year that gained 25% for stocks. I don't know if we're going to gain 25% this year, but I do think the potential for a 6 to 8% pullback sometime before the election is really high. That's what we're trying to let people know. But again, it'd probably be a chance not to panic, right? What Eisenhower say, plans are useless, but planning is everything. Plan for some scary headlines ahead of this election, but the underlying pinnings of the economy are still solid, so we still think it's a bull market.
All right. Ryan Dietrich, great to catch up with you. Thanks so much for taking the time just after the market open. Carson Group Chief Market Strategist. Great to see you, Ryan.
Thank you.
Coming up, everyone, American Express hiking its full-year EPS forecast despite missing revenue estimates. We've got some top trending tickers coming up next. American Express boosting its full-year EPS forecast after reporting double-digit card fee growth for the 24th quarter in a row. Yahoo Finance's executive editor Brian Sozzi has the breakdown for us. Shares moving lower here this morning, at least.
Yeah, right. I'm not going to reread the entire earnings release. You want to do that, go to Yahoo Finance or SEC.gov. I will say this, 25-cent earning beat, sales up 9% year over year. Those things were all good. And I got off the phone with American Express CEO Stephen Squeri just moments ago, and he got the same question that I'm going to ask every single CEO I talk to over the next 3 weeks of earnings season. How are you thinking about the back half of the year in the state of the consumer? I put out a good chart on my X account yesterday, really talking about how consumer confidence has started to weaken over the past 3 months. So there is that, and that comes despite a strong jobs market. There's that, of course. And then what is the state of the consumer into election season? Here's what Squeri is telling us. He's telling us they're still being Amex. Amex is being Amex. The company is going to just continue to invest in his business very aggressively, telling me he's not planning for any more caution in the second half of the year. He is noting that Amex has been around for 174 years. Has been around for 30 presidents. I like those little fun facts, saying they're still going to go out there and sell charge cards to millennials, which they're having a lot of success doing, and they're going to make a lot of money. They're going to roll out close to, I think it's 40 new product updates. There's an update to the Amex Gold Card coming in a few weeks, Squeri told me. So there's all of that. So no real caution apparently baked in that second half outlook for Amex. I will note, though, not everything is sunshine and rainbows. You did see a slowdown in that travel business for the company, not unlike Brad. I think maybe what you saw and heard for Delta when you talked to CEO Ed Bastian. Those companies work very, very closely together. So there might be a start of a travel slowdown. I asked Squarey, is that a canary in the coal mine for the consumer? He pushed back on that, doesn't see that as consumers getting cautious ahead of the election. Whatever the case, this company is still going to rake in money this year, next year, and probably the year after. I would also call out a couple takeaways here, too, for Amex. One that left an impression with me, and I think is surprising the market here and why you're seeing the negative market reaction. Amex, out of the blue, is taking up an already hefty marketing spend by $800 million, not $8 million, not $80 million, $800 million to $6 billion this year. So I asked Square, I'm like, where are you spending all that money? I mean, ads on Yahoo Finance? Well, he didn't say no, he wouldn't be open to doing that, but he did say he's going to go out there and market more to millennial customers this year. They've had a lot of success in doing that, so I would expect more ads coming from Amex in that department. And then, as I mentioned there, travel weakness, and then a big year for product updates as well coming from this company. Probably one of its biggest years since I've been covering Amex for 6 or 7 years.
Brian, I'm curious, just going back to the consumers and the spending, you're saying it's not all butterflies and rainbows, obviously. Are they seeing any difference in terms of who is spending or I guess did they identify maybe more specifically where they are seeing that strength versus some of the weakness and where they are seeing maybe more of a deterioration?
Amex is a really interesting company to cover because when the consumer does in fact weaken, I think they pull back on Visa and MasterCard. There's just something about this Amex customer that is very sticky. I think it's a lot of the perks that Amex offers on this card. Of course, you're paying for those perks via that annual increase or annual fee for Amex cards. But they've done a really good job adding more products, bells and whistles, that would make you think twice about not re-upping that fee each year. And I think you're seeing baby boomers continuing to be baby boomers. They are now retiring more aggressively. They're out there spending their hard-earned savings. Good for them. And of course, that's a key Amex customer. But what befuddles me a little bit, Sean and Brad, is the millennial customer that this company continues to bring into that network system. This rate at which they're spending is amazing. And it's not a year, 2 years, 3 years. Every time I talk to Squarey over the past 3.5, 4 years, the millennial customer has been strong. All we hear about millennials is they have no money. I mean, this is a topic on wealth, I'm sure, Brad. Yeah. Some millennials are out there spending. I mean, they have money and they have a job and they're clearly using their Amex cards.
Well, also in some of the peak earnings years as well that we've just begun to enter into, all of us, I guess, millennials. I know you're
Hey, I haven't peaked out yet. I'm just trying to take off, Brad.
There's a range of millennials. You can't leave us.
Yeah,
you just happen to be one of the early adopters of millennials.
In my incomes. Oh, look, it wasn't like 10 years ago, I was outside Penn Station, New York City, scrubbing Wi-Fi for free. I had like $100 in my bank account. So look, I mean, I'm just trying to still take off. I'm doing okay. We're all doing okay. And that's all good things.
We all had to scrub Wi-Fi from Starbucks. And
it's a rite of passage.
It is.
It's a rite of passage.
Actually, these Gen Zers will never have to deal with
it. It's an honor to be here.
Anyway, Brian, thanks so much. We've got all your market action ahead. Stay tuned. You're watching The Morning Brief.
SunPower shares plunging after notifying dealers that as of September 17th, it will no longer be supporting new leases. It will be halting shipments. This comes after the company's April announcement that it will have to restate nearly 2 years of financial results. We're looking at losses. The stock just above $1 a share, off 31% right now. Piper Sandler and Evercore both suspending their coverage on SunPower following this letter here to dealers. You have Guggenheim analysts believing that the news effectively marks the end of SunPower as an operating business. And you can see that reflected in the reaction that we're seeing in shares today here, Brad.
No, that is extremely alarming. And I think investors are doing the right thing in dumping where we have seen to that extent over today's activity down 31%. Look at that 5-day activity down by about 60% in 5 days and 3 months, down 52% here. They say that they continue to dedicate their attention to address the financial position, actively working to navigate the current challenges here. And this stems back to some of the internal documents that were originally reviewed by Reuters, confirmed by the company as well, informing clients and telling them that they're going to be having some operations that will be paused, lease and power purchase agreements that would be deactivated as well from its sales platform, plus not putting out new product shipments here.
Yeah, and also just going back to that Guggenheim note, so you're asking maybe what exactly this means for others within the space. The team there noting that market share is up for grabs. They actually see Sonova Energy as the most likely beneficiary here, given their dealer-focused model, also willingness to pursue growth. So again, when you're trying to identify maybe other potential beneficiaries there, Guggenheim naming a Sonova Energy as one of those names.
Absolutely. Another name that we're tracking here this morning, Plug Power, that is sinking. It's down by about 13.5% after saying it's begun a $200 million stock offering. Now, this comes as questions arise around the state of the company's finances. This is a liquidity play. However, you're seeing it also be an impact to the shares because typically when there is an additional offering like this, it is a dilutive event to existing shares that are in the market. So a typical reaction, but there have long been questions around some of the capital position for this company to continue operating as it has been trying to scale up as well.
Yeah, exactly. Taking a look at the quick analyst reaction to this news, KeyBank saying that the equity issuance is likely to lead to further weakness that we're seeing in shares as liquidity becomes more and more of a concern. Piper Sandler saying that they expect to see questions about the rationale of an offering in lieu of the existing cash burn here that they are saying. They also went on to say that it's unclear how much cash Plug drew from the existing here between beginning of May and end of June. So again, analysts having some questions on this news, but like you were saying, Brad, not necessarily a surprise to see the shares reacting the way they are today.
All right, in the red. Guys, coming up, Morgan Stanley upgrades ARM. We'll tell you why the firm is bullish on the stock. That's coming up next. ARM shares are higher by about 2.75% after Morgan Stanley upgraded the semiconductor company to overweight from equal weight and raising its price target from $190 or to $190 from $107. All right, switching digits. Anyway, it's now at $190, folks. The firm optimistic about its power-efficient computer architecture and developer community. This after a broader sell-off this week in the chip space after the Biden administration reportedly seeks to tighten restrictions on semiconductor exports to China. And so as we're taking a look at the SOX index, which houses some of your favorite semiconductors, you're seeing that over the past 5 days slipping here. They note significant growth and the possibilities there in some of the key markets that ARM operates in, and also looking across some of the royalties. Of course, this is where the company had updated their business model, looking at more of a royalties-based business model for use cases of the chips versus what it was prior, and just making sure that they've ultimately they updated the revenue model. But at the end of the day, smartphone royalties, they're expecting that to get to $1.87 billion by fiscal year 2027.
Yeah, and autos, where they also see royalties there, more than double by fiscal year 27 there. So again, they have the smartphone side of things, auto side of things. Again, a very bullish call here from Morgan Stanley. When it comes to the other advantages that they see for ARM Holdings, we're talking about new designs. They're also talking about extensions there. And also going back to those smartphone comments that you made just a second ago, they also mentioned the fact that it would be helped here by a strong iPhone upgrade cycle. So again, tying it back to some of the movement, some of the excitement that we've seen surrounding Apple. This analyst here making the case that ARM clearly one of the beneficiaries of that, given their exposure in the space. All right, keep it right here on Yahoo Finance. Coming up, we're going to take a deeper dive into the catalyst driving tech stocks lower. And later, top Democrats aren't holding back on their calls for President Biden to drop out of the 2024 election. We're going to break down ultimately what this could mean for the markets. Coming up next, Catalysts. Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the trading day. Let's get a check on the market action and the catalyst moving markets here today.
We're seeing a little bit of a rebound, at least some of the tech stocks coming off of their lows this morning after the NASDAQ composite suffered its biggest single-day decline since 2022. The NASDAQ and the S&P poised to close the week ahead lower.
Plus, a global IT outage linked to cybersecurity software CrowdStrike is affecting businesses all around the world. We're going to tell you how the company plans to address the issue.
And will President Joe Biden drop out of the 2024 election? The president facing increasing pressure from Democratic leaders to step aside. We're going to discuss the next steps for the party and the potential market impact.
Our top story of the day, the global IT outage rippling through multiple industries across the world. Massive tech disruptions linked to CrowdStrike are affecting businesses across the world, including airlines like United and American, as well as shipping and freight stocks. FedEx, Union Pacific are among the latest names coming out saying that their companies are experiencing some delays over shipments. A statement from the New York State Chief Cyber Officer saying that there is not yet a timeline for full restoration from the outage. Now, CrowdStrike shares are sinking. For more on what ultimately this means for CrowdStrike going forward, we want to bring in Shaul Eyal. He is TD Cowen's managing director. Shaul, thanks so much for hopping on with us here this morning. If we could just put up an intraday chart here of CrowdStrike, because we did see a huge movement to the downside ahead of the open. Shares had been off just around 15%. Now we're looking at losses of about 9.5%. How are you looking at what ultimately this outage means for CrowdStrike specifically here going forward?
Absolutely. Thank you for having me. I think what we have seen over the course of the past hour or so, this kind of swing back to from 20% down to 9% right now, is management being able to come out, properly address the early part of the outages, come out with some sort of an early message that this is first, it's not a cyber attack. This is an outage. This is an unintentional type of outage, more of an update related, reversible type of a problem. It will take probably a couple of days to rectify and remediate that. But I think the straightforward message that it is under control, I think, has been alleviating some of the initial concerns earlier in pre-market.
Shaul, I want to take a step back because I think for people at home who aren't experts like yourself, they're looking at this and thinking, how do we get to a place where our world can seemingly crumble for a lot of folks this morning who are traveling, for example, because of one or two companies? Give me that context, and especially for our viewers who are feeling concerned about that.
Absolutely. The field of cybersecurity and the need to detect, respond, remediate, and defend so many applications, I think that pretty much kind of shows how mission critical it has become. I think we have been seeing a gradual shift to consolidate the market, whereby enterprises have been using a couple of vendors rather than multitude of a big number. I think that could potentially be questioned longer term. I think some of the infrastructure which has to do with that consolidation also could potentially get another boost longer term. I think that, again, the consolidation around a handful of players, by the way, as we have seen in some other tech arenas, could potentially be questioned longer term.
Shaul, is there a way to prevent something like this from happening again?
I think that constant cat and mouse chase between bad actors, white hats and kind of black hats, I think that pretty much is likely to remain, unfortunately, unchanged. I think it's not a matter of if customers, enterprises are going to get hacked. It's just, when. We are yet to see one conclusive solution that pretty much shields the entire organization. At times, as we have seen today, it's an unintentional update. So again, not a cyber attack. But I think we're still long from these days whereby we could be able to announce that the cyber security issues have been one and foremost resolved. This is a very, very unfortunate fact.
And we should mention it's not just, of course, these cyber stocks that are being impacted today. We've been covering all morning the bank names, the retailers impacted, just to name a few. From your perspective, though, as someone who focuses specifically on these cyber names, how much of an impact could a day like today potentially have on those company earnings moving forward?
I would imagine in the near term, as we head into a second quarter earnings season, probably it wouldn't be much of an impact. I think it will have to do pretty much with the second half of 2024. And as we start taking a peek into 2025, what we could be seeing within this time frame is actually a little bit of an emergency spending patterns that, by the way, we had seen with such sizable former cyber-related attacks and outages. So you can argue from a near-term perspective, actually today, which on the one hand, very, very unfortunate to many verticals and customers and patients and what have you out there. Longer term, from a near-term perspective, we could be seeing actually upside to some of these companies' results and estimates.
So when we look at the market's reaction, we mentioned the fact that CrowdStrike shares obviously are under pressure, not necessarily a surprise, but some of their competitors are catching a bid today. You look at Palo Alto Networks, that stock is in the green. Also look at a name like SentinelOne, shares there up just around 4%. Are those stocks going to benefit here, or do you see them potentially benefiting because of this issue here from CrowdStrike?
I would imagine also that the issue of the need to beef up redundancy could bring up several names, as you've mentioned, as potential beneficiaries. The fact that maybe an enterprise cannot base their entire infrastructure or on one or two providers with a need to go maybe 3, 4, and more than that could be broad-based beneficial to many of the names. SentinelOne, given they compete head-to-head with CrowdStrike, Palo Alto also in that respect, I think are being viewed right now as near-term beneficiaries as we think about their end-to-end platforms.
Shal, we got to leave it there. Thank you so much for joining us on this developing story this morning. We appreciate it. That was Shal Eyal, TD Cowen's Managing Director. U.S. stocks, we're going to focus in on those recovering from some of their earlier losses, at least in the S&P, just about flat. The NASDAQ up about 0.1%. The Dow still under pressure, but this comes as investors are focusing on the global IT outage hitting major businesses after a week of downward pressure across the major indices. The NASDAQ earlier this week shedding more than 3% of its value just over the last 5 sessions. So for more on the broader market moves as we close out the week here, we are joined by Simeon Hyman, ProShares Global Investment Strategist, on set with us. Simeon, thanks for being here.
Thanks for having me
this morning. So talk to me about what you think this week means moving forward, right? For me, it seems like an indication that it's time to get a little bit more picky.
Well, we're calling the second half of the year a clear reminder to focus on the basics of asset allocation. Do we know if this small cap thing is the inflection point? Do we know if a little bit of pullback in tech is it? No, but we know some things from history. As an example, 10 years after the tech wreck, large cap stocks were still in the red, but mid and large cap stocks had long gone in the green. So these are critical reminders that, hey, you can't time the market exactly. And we've all been talking about how cheap everything but the Magnificent Seven is. But don't think about it so much as a market timing thing, but more as appropriate diversification that people may have forgotten about.
Mm-hmm. So what does that mean that investors should be doing now when they see this rotation, what has played out over the last couple of days? How should then they be positioning their portfolio for the remainder of the year?
I think first you have to have appropriate diversification within the equity markets, and that means mid and small and even in international stocks and things like dividend growth stocks that have been left behind for no good reason. But another key element here is the importance of having your fixed income, your bonds be bonds, and your equity be equity, because bonds aren't broken anymore. We now have a 4.25% yield on the 10-year Treasury. If we're wrong, if something goes wrong, felt like Y2K this morning, it's bizarre. But if we have a recession and the equity market retreats, now you can make 10% in your bonds. Hasn't been true in a generation. The flip side of that is make sure your stocks are stocks. Make sure they behave that way. So there's a whole realm of
What
buffer.
does that mean? What do you mean by that?
There are a whole realm of buffer strategies and collar strategies. We used to call them 5 and 5 strategies back in my day. 5% return, 5% volatility. And that you needed them when bonds were broken. When bonds had a yield of 50 basis points, they couldn't go up if anything bad happened. So you needed these things, but you don't need them as much now that bonds aren't broken. Take covered call strategies. They're an incredibly well-known, very popular strategy, but historically, traditional covered call strategies have returned 1/3 of the equity market. It's not enough. If you're a little worried about the equity markets, you're 60-40, go 50-50, have a little bit more bonds. Instead, if you're looking for equity and you're looking for equity income, we put out an innovation called iSpy, the ticker is ISPY, by using that new innovation everybody's been talking about, daily options. You can deploy them as a daily covered call strategy, get the income, but also the strategy behaves just like equity. So diversify your equities, make sure you have the bonds, but make sure your stocks really behave like stocks.
It makes me wonder, though, about the volatility that a week like this showed us, right? I mean, let's look at the month. We're supposed to have this easy summer where we're relaxed into earnings, and then you've got, is Biden stepping down? You've got the RNC, the attempt of the assassination against the former president, and then today the world seemingly stops. Is your solution to that just being kind of diversified and having a little bit of your hand in every single bucket? Or does it need to be even more specific than that when you're picking companies that you think can ride through any volatility?
So here's a very important reminder. This morning I was listening to, earlier on your show, this notion that tech is quality now and it's kind of okay because it makes money and it was all eyeballs and sock puppets back in the day. That was not true at all. People are forgetting it was the S&P 500 tech sector that was at the top of the heap in '99 and the beginning of 2000. It was making tons of money. So I think the key to managing this risk is to understand that the risk is not necessarily just one of price, but it's also of fundamentals. So you have to look for areas of the equity markets that are likely to have sustainable earnings. That S&P 500 tech sector went from doing incredibly well in '99 and 2000 to actually generating negative return on equity by 2002. And if you're looking for signs of stocks that have more sustainable earnings path, look for ones that are telling you they are. Companies that increase their dividends, they're literally telling you they feel good about the future because nobody ever wants to cut a dividend. It's a lot different than a buyback. Everybody talks about buybacks in tech, and that's telling you a good year was last year.
So, I mean, what's your base case just in terms of what ultimately the Fed is going to do between now and year-end, given the data that we do have today? And are we making too much about the timing of the first rate cut rather than focusing on some of those fundamental issues that you've been discussing?
Thank you for serving me up my standard line, which is it's not so much about the Fed. The Fed doesn't matter that much.
And that's still the case.
And why do I say that? It's because if you think about the yield curve, if we had 2% inflation, and we're getting close, if we had 2% inflation, a good guess for Fed funds would be 3, and a good guess for the 10-year would be 4, 4.5. Which one of those already happened? The 10-year is already in a stable place, and it's the long end that drives stock valuations. So is there a little something when the Fed ultimately cuts? Yes, but the normalization of the long end of the curve, in addition to meaning that bonds aren't broken anymore, means that we shouldn't expect a downturn in the equity markets if the Fed's a little late, nor would it likely be a tailwind whenever they do cut.
All right, Simeon Hyman, always great to have you. Thanks so much for hopping on set here with us today. All right, the Republican National Convention wrapping up last night, former President Trump accepting his party's nomination. Now, the attention shifting to the Democratic side, rumors swirling that President Biden may bow out of the presidential race as early as this weekend. Here to discuss, we want to bring in Bill Kristol. He is the Bulwark editor at large. Bill, it's great to have you. So I'm curious where you stand on the reporting that we are seeing and whether or not it's more of a question of when this is going to happen and ultimately what that timing means.
I think it's likely to happen, but, it's not certain. He's very stubborn. His campaign manager was on TV this morning saying, oh, no, he's not going anywhere. But it's not just rumors, obviously, at this point. We have very good reporting about what Nancy Pelosi, the former speaker, is doing. Senator Schumer, the majority leader, Hakeem Jeffries, the current House minority leader, various governors, they are all on board the notion that President Biden's going to lose, most likely. And also, they can't really make the case that he's the right guy for 4 more years. He's done a good job as president, they would all say. but can we really look at him and say, at age 81 and aging, that 4 more years is right? So I think there's an awful. I've never quite seen in my days in Washington this much coordinated pressure, almost universal, I'm going to say, from the serious leaders of the party. Some of them are saying it, some of them are not saying it. But Biden can be stubborn.
It's interesting because you say it's a coordinated effort. I was just thinking about some reporting we had on AOC last night, talking about the conversation she's been having with her peers in Washington about the next step, right? If Democrats are saying you don't want Biden on the ticket, okay, then what's the process? What do we see at the DNC? Where do we go from here? Is it just Kamala? And from her point of view, that's where the conversation starts to go off the rails. There's not a lot of clarity to that end. So from your perspective, Bill, does that lack of clarity lead to some questions about the state of democracy for voters that feel like they're not really getting a say in who's going to be on the Democratic ticket?
I think it's paralyzed, or at least made some people pause, as you would expect. I mean, the analogy someone used is, you're in a car that's heading towards a cliff and it's not slowing down as much as you'd like for you to jump out. You still have to jump out, Now, you would prefer to jump out when it comes to a full stop, but if it's going at 20 miles an hour, better than 60 miles an hour. And I think people are overdoing a little bit the notion that it would be total chaos. Okay, it would be a little crazy. We haven't gone through this that much recently. Maybe Vice President Harris would sew it up very quickly. Everyone would be for her. Maybe there'd be a competition, kind of a mini primary, some debates. You guys could host them all. Host the 3 or 4 who wanted to run and make their case to the delegates on your show, and everyone else could do the same. There'd be town halls. People would do some campaigning, and then the delegates would meet and vote at a convention. Is that really that chaotic, that impossible to imagine? And I don't really buy the argument personally that everyone's feelings would be wounded and there'd be bitter divisions. Really, the Democrats are going to unite against Trump, and they'll be excited, I think, by a little seeing these younger candidates, and you'll end up with a younger ticket and a better ticket. So I think people have come to that view gradually. I'd say 3 weeks ago, I've been pushing this for quite a while, so I'm somewhat familiar with the pushback to it. And the pushback 3 weeks ago, 4 weeks ago, certainly before the debate, was, oh my God, it just would be so impossible to pull off. And there'll be Harris supporters and Pritzker supporters and Shapiro supporters. And, they'll actually have 1 or 2 arguments with each other. Now people are like, can we just get to this and have this process go and get to a younger ticket?
Bill, I'm curious what you make of the transformation that we've seen within the Republican Party, because that really has been on display these past couple of days through the speeches that we've heard, almost everyone who took the stage, and ultimately how you see that shaping the economy and then ultimately the markets here if we were to see Trump elected as the president in November.
I think people are too reassured by the first term, where Gary Cohn and a million other people stopped Trump from doing a lot of stuff he wanted to do. And Paul Ryan was the House Speaker, and Mitch McConnell was a powerful Senate Majority Leader at that point. And they basically implemented mostly a traditional Republican agenda, for better or worse, but it was pretty good for the markets. And that is no longer the case. Paul Ryan's not the House Speaker, and Mitch McConnell is not going to be the leader, and there are not going to be a lot of Gary Cohn's and Mike Pence's and traditional business-friendly Republicans in this next administration. I think Vance's pick is very important, the pick of J.D. Vance. He's committed to an America First agenda, which involves anti-immigration, nativism, but also protectionism, tariffs. Everyone's laughing at the tariffs. I think he could do it, And so I think people need to factor in a much more Trumpy Trump second term than they remember from the first term.
Really quickly here, Bill, if you are thinking through factoring that in, what is the single biggest impact that could have from the foreign policy side of things if Trump does enter office again come November?
I think Ukraine is in very, very bad shape. Putin is emboldened. Other dictators are emboldened. I think global instability would be real and would happen pretty fast if Trump won.
Bill Kristol, always great to get your insight. We look forward to talking with you more here over the next several months. Thanks so much for joining us here this morning.
Thanks.
Got much more of your market action ahead, about 50 minutes into the trading day. We're still looking at losses now across the board. You've got the NASDAQ just under the flat line. You've got the Dow off just over 200 points. The S&P also now just slightly in the red. More on that coming up. You're watching Catalysts.
Let's look at some trending tickers that we are watching this morning. Shares of Halliburton moving to the downside, down over 4% after reporting revenue in the second quarter that missed Wall Street estimates. Breaking it down by regions, North America revenue fell 3% to $2.5 billion, while international revenue was up 3% at $3.4 billion. Now, shares were down nearly 7% right after this print, which would have been the biggest intraday move since May of 2023. As a reminder, this is the oil field services company missing on those revenue expectations. We have some analyst commentary in from JP Morgan saying they did not believe the market was anticipating a 2Q 2024 top line miss across the board here, referring to the firm's North American business in particular. Also, its production segments down, and the market was expecting a small guide down. It sounds like a modest guide down for 2024 guidance, but we're seeing a little bit of a negative reaction given that that is not exactly what we got from this print today.
Yeah, exactly. They could characterize it as maybe a slightly negative knee-jerk reaction in terms of what we are seeing. So clearly weakness here in the North America side of the business. But again, analysts pointing out some of the strength that we did see within this report. They talk about the fact that Halliburton now sees, quote, some recovery in the natural gas activity in 2025, also some strength on an international level, offsetting some of the weakness that we did see here in the U.S. So again, the fact, though, that I think that miss on the revenue line, the fact that they did see weakness in those two key areas, like you just pointed out here, Maddie, is a big reason why we are seeing the extent of the sell-off that we are here this morning, with shares off just about 4%. Let's also take a look at its competitor, Schlumberger, moving in the opposite direction. The company beating estimates on both the top and bottom line. Growth coming from the firm's international segment. A bright spot here for Schlumberger. That's also what we saw from its rival Halliburton here. But for SLB, that segment, sales rising 18%. We're seeing a lot of that really driving the market's at least instant reaction to this report. Schlumberger's SLB's CEO saying that looking ahead to the second half of the year, we expect ongoing momentum in the international markets. Also went on to say that beyond 2024, the fundamentals of this cycle remain in place. So again, the street's encouraged by the results that we got, the commentary here that we're getting from executives, and again, sending the stock up just over 3%, Maddie.
The broader story that we can tell about both of these names, at least initially, is that we are seeing more international activity. And this is coming amid a little bit of a decline in domestic shale activity. That's what we can draw out that we're getting in terms of looking under the hood of both of these earnings prints. You are seeing some more of that international demand. I want to pull up a quote from SLB's CEO saying, looking ahead to the second half of the year, we do expect ongoing momentum in international markets. Beyond 2024, the fundamentals of the cycle will remain in place, but called the international growth potential a tailwind for the company. So it'll be interesting to see to what extent that remains to be the case. SLB is an indicator and kind of a bellwether for the broader oil and gas space. So this could be an indication of some earnings that we are still anticipating to come and give us a sense of kind of the financial health of the energy sector in particular as we prepare to get some more earnings prints coming in here. Now, coming up, former President Trump taking aim at electric vehicle mandates during his RNC speech last night. We'll get a Tesla shareholder's reaction to his comments when we come back.
Former President Trump not wasting any time with his attacks on the Biden administration's green energy policies, taking aim at electric vehicle mandates last night during his acceptance speech at the Republican National Convention.
And I will end the electric vehicle mandate on day one. Thereby saving the U.S. auto industry from complete obliteration, which is happening right now, and saving U.S. customers thousands and thousands of dollars per car.
All right, we want to bring in Brian Sponheimer. He's Gabelli Funds portfolio manager, also a Tesla shareholder. Brian, you're the perfect person to talk to here this morning. I want to zero in on what we heard from former President Trump last night, also following his VP pick, Senator Vance's comments attacking the EV landscape. I'm curious what you make of this from an investor standpoint and ultimately the implications and what this could mean for Tesla specifically.
Yeah, thank you very much. And just for one clarification, I don't own Tesla in my funds, but they're owned within the Gabelli Funds organization. No real surprise from former President Trump last night. The issue of electric vehicles as part of the IRA, the Inflation Reduction Act, has been a political football for quite some time, and clearly a political speech at the end of the Republican National Convention. It was no real surprise that was going to come up. The question is, should former President Trump be elected, whether he could actually repeal those pieces, those $7,500 EV tax credits, the $4,000 for used vehicles. It remains to be seen, but clearly the domestic auto industry is one that has been trying to play catch up by and large, with the exception of Tesla, to the Chinese for some time. The concerns that Chinese auto manufacturers are going to come in through Mexico to sell cars in the U.S. is a major concern, particularly for the Republican Party. And so, it's really more of a wait and see mode, but certainly no real surprises last night from former President Trump as it relates to the EV industry.
I want to broaden this out a little bit because there is this question out there about what Elon Musk does to potential Tesla consumers. And there's obviously a big difference between Tesla, the stock, and Tesla, the company, and the fundamentals. What can you tell us about the potential impact that Elon Musk's support of former President Trump could do to Tesla sales moving forward?
Well, I think by and large, Tesla sales for the first decade or so were by people who supported Elon Musk's vision for an all-electric future. Clearly, EV sales have been hit over the course of the past years. We've had kind of a bit of a market saturation from a demand perspective. Whether or not Mr. Musk's support for the president to the tune of $45 million a month, or about $180 million through Election Day, has a real impact by more of his the potential for left-leaning consumers to buy Tesla vehicles. I think it remains to be seen. I think you're really talking about a very marginal buyer that's going to base his or her decision on whether the CEO of Twitter or X is supporting former President Trump.
Brian, what have you seen in the past just in terms of customer behavior when you take a look at what we have seen for past buying power and I guess the ability to spend, or willingness, maybe is a better way to say that, to spend from consumers? Have we seen boycotts like that in the past? And I guess how closely are you tracking that as a portfolio manager?
It's a really good question. I think most of the time from a consumer perspective, it's been short-lived. On the other side of the fence, you have Bud Light, where we've clearly seen sales for the past year drop off a cliff, so to speak, for some of the marketing materials that they put out. So it's not necessarily something that I think is too concerning. As typically speaking, major corporations have avoided taking major stances from a social or political perspective, but we're watching it, and it's not a real big concern right now, but something to keep an eye on as we move forward towards the next few months into the election on November 4th or 5th.
I wonder if I can switch gears a little bit away from EVs, because I know you also look at infrastructure, Brian, and former President Trump and Biden have kind of found in different ways a little bit of an aligned thinking on policies that would be bringing manufacturing home to the states, which would really shake up our economy, right? 75% of our non-farm payrolls are in the services space. Bringing that into a more manufacturing-driven sector would be a huge economic change. How is the potential of those policies from either candidate impacting your investing outlook?
Well, I think going back to maybe some of the stimulus that's been passed over the last several years, we have mega trends that aren't going to go away no matter who is elected in November, right? We have infrastructure, we have nearshoring, we have the CHIPS Act that is going to continue to provide opportunities for construction and semi-fab manufacturing. So there's a lot going on that really I think is a positive for non-res construction spending within the U.S. It's going to help companies within the equipment rental space, companies like United Rentals and Herc, HRI. It's going to help some of the machinery manufacturers, such as a small cap company like Aztec, ASTE out of Chattanooga, Tennessee. So there's a lot to be excited about, I think, as it relates to the machinery sector over the course of the next few years, as the money from some of these stimulus measures starts to really work its way into the broader economy. And whether it's former President Trump, President Biden, the focus on American job creation, largely through, I think, manufacturing and largely through construction, I think is going to be similar from a policy perspective.
All right, Brian, we're going to have to leave it there, but really appreciate you joining us this morning. That was Brian. Thank you. That was Brian Sponheimer, Gabelli Funds portfolio manager. Now, coming up here, we've got more news for Eli Lilly's weight loss drug, what the latest approval signals about competition in the space. We'll have that for you next. Eli Lilly's weight loss drug gaining regulatory approval in China. This comes about a month after Novo Nordisk's weight loss therapy got approval in the country. Yahoo Finance's Anjali Khemlani joins us now with the details. So Anjali, obviously leading to a bump up in the stock price, but what do we know about the fundamental story here?
Yeah, so this is good for Eli Lilly, obviously. They're entering now one of the largest economies, one of the largest populations for obesity. So this is really good for the company, and it also signals that we're moving a little little bit away from that crunch on production for Eli Lilly and also with Novo Nordisk. While there still are shortages out there, this signals that they're working on and are able to produce enough to start opening up those markets. So the approval for Zepbound now in China, they already had approval for Mounjaro, that's the diabetes version, matches now what Novo Nordisk has. So now both companies are using both products in this very big market. China continues to be one of the biggest markets for drug companies, especially because it is a national and private as well a market for these drugs for the healthcare system. So it really opens the door for opportunity there and will continue to be a big one for them. And like I said, it's going to be just great in terms of the doses that are available for everyone around the world. So we could start seeing this pick up elsewhere in the globe.
All right, Anjali, well, thank you so much for joining us. We really appreciate it. We're going to do a quick check on the Russell 2000, somewhat of the star of the stock market this week, but looking at declines today, which could be driven by that IT outage or some broader movement and thinking on the rotation. We're still going to discuss that, though, because the Russell's still up for the week after that multi-day rally. Our next guest closed his underweight rating for small caps last week, and he's joining us around the table to discuss. We've got Brian Nick, New Edge Wealth Managing Director, here in studio. Brian, thanks for being here. So let's start on the movement in the Russell, because do you think that that is driven by kind of too much too soon in terms of the rotation this week?
Certainly can be a very kind of powerful counter rotation. Every time people get enthusiastic and they at small cap, there was so much negative sentiment around it, negative positioning. It was oversold, underowned. We see our clients don't own enough small cap according to sort of where our advice would tend to fall. So these things can be very powerful. I think the last 2 days, it seems like you've seen a bit of a rethink, maybe people exhaling, taking a breath. Interest rates going back up, that's not going to help small cap. Part of the reason we took the underweight off would be because our conviction increased that we weren't going to see another big leap higher in interest rates. That inflation number was a big one, that June CPI number. And we saw the risks as more asymmetrical, pointing to either rates staying where they were or going to the downside. And that was a big reason why I think you saw this rally over the previous week. So if rates are headed higher again, get the yield curve steepening, that's not going to be as unambiguously positive for small cap.
So talk to us a little bit more about that small cap strategy, exactly what you're emphasizing, and if you were in fact maybe to see more opportunity going forward, if everything plays out and your next move were to be overweight, kind of what you would be trying to identify or looking for.
I think if you asked everybody on our investment team, we would say the next move is just as likely to be back to underweight as it is to overweight, because we're a bit more cautious on growth as we go forward, and the earnings estimates for next year for small cap are extremely demanding already. So we really need to see good fundamentals, better growth data kind of help the earnings backfill some of the optimism that we're already seeing. The strategy that we're employing is we're not adding Russell 2000 exposure, we're adding S&P 600 exposure. It's a little bit of a different benchmark. It's narrower. You need to be more profitable. You need to have a track record of profitability. It's also going to tend to emphasize higher quality earnings. And so we could see more of sort of a junky small cap rally where we underperform, but we're happy to be in that category because we want to emphasize, again, in what could be a slowing growth environment, one where the Fed rate cuts are already priced in, so a lot of the good news might be behind us. We want to make sure that we're investing on behalf of our clients, and we want to make sure that we're not taking too much unnecessary risk with companies that may not deliver next year.
So what does that look like in practice, though? I feel like what you just said is really important. Does it involve more stock picking to a degree, or are you still happy to own the broader space, but S&P 600 versus the Russell, and that's your way of stock picking?
Yeah, so if we're running internal strategies, we're going to tend to emphasize sort of benchmark selection as being an important component. When we're looking at managers that we want our clients to invest in, we're going to emphasize managers that have more of that quality, more downside protection, maybe a little bit less participation on the upside in exchange for a little bit more downside protection, which again, for small cap, we think of like high beta, cyclical, riskier, more volatile. That's not necessarily the posture we want heading into the end of this year and into 2025.
When you talk about the scenario of a soft landing, how big of is that, to an extent? You were talking about so much of this optimism already being priced in. Is that essentially a catalyst here for small caps? And I guess, how are you then positioning beyond small caps, given the fact that that type of scenario, you could argue, would benefit almost across the board?
Yeah, so that's when we talk about a soft landing. It pretty much means everything in your portfolio is going to be doing well, especially from this starting point. So we're just as likely to recommend longer duration, higher quality bonds in that scenario as we are small cap stocks. It's sort of it's a Goldilocks scenario. It doesn't happen that often. So if you replay like the 1995 playbook, which most investors really weren't around for at this point, small caps did extremely well in that scenario. There are some differences, though. We're already seeing unemployment moving up. There's a really interesting paper published by 2 economists at the Minneapolis Fed just today that pointed out that we might be seeing layoff rates actually starting to increase more than the official data would suggest. So that's one reason we're somewhat cautious. One of the trades we did at the same time as we moved this small cap underweight to neutral was we actually took high yield bonds to a bigger underweight. These two things are normally pretty correlated, but we want to find ways to de-risk prudently in portfolios, especially where we think things are expensive. The nice thing about small caps is you can't argue that they're expensive at this point compared to some of the higher flying growth names. But when you look at the fixed income portfolio, bonds are actually paying you a lot to own them right now, especially compared to the previous 20 years. And high yield bonds just don't give you enough of a pickup on yield. So we took the opportunity to move that down to underweight while upgrading small cap. Those two things are normally, again, positively correlated, but just from a value perspective and a risk control perspective, that's how we're shifting portfolios.
Explain to our audience what that means about the 60-40 portfolio then, and what you just said, how that impacts how investors should be thinking about 60-40.
So in the soft landing, the 60 portfolio is going to do really good. We know that in a scenario where inflation starts to pick back up or maybe just doesn't moderate to 2% like the Fed seems to expect now and the market seems to expect, that's going to be less good for both the 60 and the 40, right? We know that stocks are going to get hit and bonds will clearly get hit in that scenario compared to what's priced in and what's expected. What we're most concerned about, though, is the slowdown where bonds will do relatively well and stocks will do less well. And that's the one that's the hardest to prepare clients for because so many investors are overweight stocks, just the inertia of the last whatever time horizon you're talking about, 1 year, 5 years, 10 years, a lot of people are overweight stocks in their portfolio because we haven't really seen that prolonged, persistent downside scenario where interest rates are falling, but stocks are also falling. And that's the one we need to prepare the most for. And so de-risking a little bit, maybe not going overweight bonds at this point because that soft landing is going to be good for stocks too. But preparing for that downside scenario is important as people kind of consider what's going to happen over the next 6 to 18 months.
All right, Brian Nick, New Edge Wealth Managing Director, Head of Portfolio Strategy. Thanks so much for joining us here.
Thanks so much.
Thank you. Well, coming up next, we will be speaking with the CEO of Fifth Third on the other side of the break. You're watching Catalyst.
All right, shares of Fifth Third Bank are in focus following the company's earnings this morning. Fresh off his earnings call is CEO of Fifth Third Bank, Tim Spence. Tim, good to see you. Welcome to Yahoo Finance for the first time. Appreciate you taking the time. I know these are busy days. Before we get into the earnings, these outages this morning or something, have you seen any impact to the bank? We're putting this question to all our executives.
Yeah, no, great question. I think there is no question. There was a lot of work going on in the wee hours of the morning here to make sure that our customers weren't impacted. I think, as you know, one of the challenges of modern IT architectures is we're all reliant on the same utilities across our cloud security and endpoint security. And when there's an issue in one place, it impacts people across sectors. So we were happy. We got the call somewhere around 1 this morning, so very early hours. And before 7 a.m., we had all of our customer channels operational and all of our back office running. So we're open for business and available to help customers when and where they need. But it's not without an immense amount of effort on the part of our technology organization. I'm very appreciative that we have done the work we have to make sure that we can respond when these sorts of things materialize.
And Tim, you have a lot of street cred in the tech field, have really a large part of your career very much focused on tech. What do you tell your team on a day like this? And how do you future-proof your bank to prevent it from getting impacted from things like this that really come out of the blue?
Yeah, no, listen, the world is so interconnected today that there is as much outside of our control as there is inside of our control. And the byproduct of that is the thing you have to focus on and drill for is resiliency, right? It's when there's an issue, how quickly can you get back up? And are you able to do it fast enough to be able to prevent any sort of a direct impact on customers? So today, the good example of the benefit of the fire drills that you run on an ongoing basis here. Because we were able to get everything back up and operational before most people were even awake this morning.
All right, let's talk about some of the things you actually do from day to day outside of all the tech stuff. It's banking and it's financial services.
A little bit of that.
Yeah, what really stood out to me on the earnings release, you noted that you're holding more just elevated levels of liquidity because of the, I believe the quote was because of the environment. What environment are you seeing and why are you holding that excess capital?
Yeah, I think our view here, right, the focus at Fifth Third has been deliver superior returns to shareholders through consistency and strong levels of profitability. We are not a company that's focused on achieving the highest levels of growth when times are good. We're focused on delivering the most consistent earnings profile and in particular, a port in the storm when things are challenging. And that obviously worked well for us last year. I think in general, the environment is pretty benign. There's more discounting going on. I think the labor market is stabilized. So there is evidence that we're going to continue to see a decline in inflation. But the other side of the equation is we have land wars going on in two important regions around the world. We have uncertainty, in particular in the rates markets, about the impact that the treasury issuance, which is going to happen, in the next 18 months will have on the direction of rates in the long end of the curve. And we're running historically large deficits here in the U.S., which historically have been difficult to maintain. So the right thing for a bank that wants to deliver a more consistent earnings profile is to make sure that we're prepared for anything that comes. And the byproduct of that is we are carrying elevated liquidity. I think our liquidity coverage ratio has been full Category 1 LCR compliant for nearly a year now and was north of 135% of the target. And that's a pretty good metric that you can compare across financial institutions. We feel very good about our ability to, handle the unexpected in addition to, what we expect to materialize here over the next 6 months.
And it's not lost on me, Tim, of course, your bank is headquartered in Ohio. Senator J.D. Vance of Ohio is now the Republican nominee for vice president. What's your relationship with him? And do you think he is as favorable toward regional banks like yours, like I think many in the market think he is?
Yeah, I mean, I don't know that I can add a whole lot beyond what Senator Vance shared at his convention speech earlier this week, so I'll let him speak for himself. But I do believe he is very focused on economic opportunity being broadly available and not concentrated in individual pockets. He's been very outspoken in technology in particular on the importance of making space for innovation and tech startups in addition to the large tech platforms that are broadly established. And to the extent he thinks the same way about the importance of a diverse ecosystem in the banking sector, I think the regional banks are well positioned to make sure that consumers have lots of options.
Your consumers are really in the heartland of America. What What are their financial standings? When you talk to them, are they as bad as some would portray them to be?
No, I mean, I think the challenge here really is the averages, right? We haven't had a recovery here over the course of the past few years that delivered, an average experience for everybody. If you were a homeowner in 2020 and 2021, if you had, large investment holdings and otherwise, it's been the best of times because you were able to lock in a low fixed rate mortgage. All asset prices are up. Deposits and fixed income are paying real interest rates again. And the byproduct of that is homeowners, and in particular high income or higher wealth homeowners, are doing as well now as they have ever. On the other side of the equation, if you have a lower income, you spend essentially your entire income on rent, food, and energy and transportation. And all those things are much more expensive today than they were 3 years ago. So I think that's the reason why when you look at the data, it would say that the U.S. consumer is doing really well on average. And then when you look at the misery index or otherwise, it would lead you to believe that there's a significant share of the country that feels like they're having a difficult time making ends meet. And that is true everywhere. It's true in our Southeast markets. It's true in our Midwestern markets. And my sense is it's true in the parts of the country where we don't do business.
Yeah, that misery index, Tim, I mean, that's always just rubbed me the wrong way. Of course, it's called the misery index. Of course, something is going to be wrong with it. But look, I appreciate you taking the time. I know these are very busy days. We're looking forward to staying in touch with you moving forward. Tim Spence, Fifth Third Bank CEO. Have a great weekend. We'll talk to you soon.
Thank you.
All right, Shauna, back to you.
All right, Brian, great stuff. Thanks so much for bringing us that interview. Keep right here on Yahoo Finance. We got much more coming up. Wealth, it's dedicated to all of your personal finance needs. Brad Smith has got you for the next hour. We'll see you on Monday. Have a good weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Netflix is planning to phase out its cheapest ad-free plan in the U.S. If you're subscribed, we'll tell you the other options that you have. And mortgage rates falling to the lowest level since March, but it's not all good news for home buyers. We'll reveal the 3 hidden costs that you should be prepared for when buying a home. Plus, a new report shows a majority of workers are bracing for job cuts. We'll dig into the data with the team that published the report. All that and much more coming up throughout today's show. But first, let's take a look at the big story today. Global tech outages linked to CrowdStrike. CrowdStrike CEO George Kurtz is apologizing for global disruptions, telling multiple media outlets that he is deeply sorry for the impact to customers, travelers, and anyone affected. And even though the issue has been identified and a fix has been deployed, businesses are still reeling from the fallout. Emergency services have been affected. Hospitals have had to delay procedures. 911 services have been disrupted in several states. Global travel has even seen flight cancellations and delays. Banks, retailers, and other businesses, they have also struggled with payment processing and error screens. Here with more on the significance of the incident, we've got Yahoo Finance's tech editor, Dan Halley. Dan, you've already got a story up about this, so we've all been monitoring this morning here. What are the key takeaways that people need to be keeping in mind in the aftermath of this particular outage?
Yeah, Brad, I think for the average person, you and me, someone stuck at an airport right now, someone who can't access their banking information, people who had doctor's appointments or hospital appointments, all of those being impacted. For the regular person, it's really just kind of buckle up. There's nothing that we can do. The CrowdStrike said that they deployed a fix, but it's not like you snap your finger and that fix immediately starts getting systems up and running again. A lot of companies like to make sure that updates are compatible with their systems, or they want to check to make sure that they actually work well or won't cause further damage. And so it's not as though this is going to be hunky-dory immediately. I think the other thing to point out is, look, this is a natural consequence of what happens when we rely on so many small companies, a small number of companies rather, to basically power the internet's backbone. This is CrowdStrike is a major cybersecurity firm. They're very well regarded, but this was an update for Windows systems. And because Windows is so ubiquitous, because CrowdStrike is so ubiquitous, it just kind of cratered a huge swath of the internet. Just looking at Memorial Sloan Kettering Hospital, they were canceling procedures that required anesthesia. 911 services in Alaska were out. Sky TV in the UK couldn't go live. Different government agencies were having issues across the board globally. And so, it just points to there's these individual points of failure that we have in these systems. And everyone's aware of it. It's not like this is, new to anyone, like, oh gosh, look what just happened. How could this have happened? This is well established. Everybody is well aware of it. It's just a consequence of everybody being okay with that.
And so, is it likely that this is an event that triggers any regulatory action?
It's interesting, from a antitrust perspective of anything like that, I don't think that's an issue here. I think when you look at the cybersecurity agencies, though, they're definitely going to look at this. The government, obviously there's going to be different people in Congress who are going to pipe up with press releases of their own saying yada yada yada, how dare this, blah blah blah. They don't really know what any of this means anyway, so it's not going to be them. It's going to be the agencies that deal directly with this that are going to really kind of probably spearhead some kind of look at the points of failure here, and perhaps how companies can try to avoid something like this in the future. I think, really, again, it just comes down to how we've structured the internet at this point. It's a small group of companies that everybody relies on. It's homogenous, where it's not just one company here uses CrowdStrike or another company here uses. A lot of companies use CrowdStrike, and Windows is huge. It's the largest desktop operating system on the planet. And so when you mix those two, so many people using CrowdStrike, so many people using Windows, in this particular instance, this is just what happens. And so, I think really what it comes down to is, would regulators look at a means of preventing something like this, telling companies to have other forms of redundancies, something along those lines? It's honestly up in the air whether or not something like that would happen, and then whether companies would comply, because this is all costly stuff. And generally, when it comes to cybersecurity, nobody really pays much attention to it until there's an issue. And so, companies, their IT budgets, they'll say, okay, cybersecurity kind of low man on the totem pole kind of, but the reality is it should be one of the most important.
Absolutely. Dan, thanks so much for taking the time here and continuing to monitor, of course, some of the aftermath of the falling action, at least as of right now. Thanks so much. Also tracking Netflix here on the day. Netflix kicked off big tech earnings on Thursday, and one of the highlights investors took away from the second quarter is that Netflix will phase out its lowest priced ad-free streaming plan in the US and France. The streaming giant removed that sign-up option in the UK and Canada last year. For more on what this means for users, we've got Jason Bazinet, who is the City Managing Director. Jason, great to grab some time with you here. First, just what should people know about how important these ad plans are to the growth of Netflix, and ultimately where we can see consumers potentially still flow into other options for the streaming giant?
Well, the street right now is grappling a bit with Netflix just because it's so darn complicated, right? You've got the base business, you have the benefit of the password sharing crackdown, and then you have the ad tier. And so the street has to keep all those balls spinning and have a view on all three. I think you correctly point out that going forward, the ad tier is going to be a bigger part of the narrative. And I would say on that front, the company's success in getting customers to sign up for the ad tier has been pretty consistent with our expectations. They're probably going to get about 80 million customers globally over the next 4 years, which is about what we expected. If there has been a surprise, it has been Netflix has under-monetized the ad revenue that they're generating off those customers. So that's where the street's really going to be focused. Can they close that monetization gap by generating more ad dollars off of those ad tier subs?
And so that comes back to pricing strategy as well. I mean, at what point do you think consumers who are trying to figure out how to cut costs or how to make sure that they're at least trimming some costs but still able to take advantage of a certain streaming platform, whether it be Netflix or whether it be one of the competitors out there, how do they best identify when they're paying too much for a service?
Well, that's tough to know. I mean, I can only tell you the metrics we look at. In the old linear model, traditional TV, consumers paid about a penny a minute. If you looked at their monthly cable bill, which is about $100 a month. If you look at Netflix's US ARPUs today, consumers are paying about half a cent a minute. So at some level, even if you're paying for the full price with no ads, you're saving a lot of money already. But for an individual consumer, if they choose to spend down from, say, the standard plan at $15.50 down to the ad tier plan at $7, that's really just a function of whether or not consumers are willing to endure those ads. I would say that the ad load is probably half. Even at maturity, it'll be about half of what linear TV is.
And so we also know that Netflix is upping its spend into content. Where do you believe that consumers should expect to see more offerings really ramped up from Netflix, especially given that they're starting to try and nibble more at live sports or live events? I should kind of generalize it more as, but also they have some of the unscripted series that they're spending on, whether it's for the Love is Blind fans out there or for anything of the like, or some of the scripted series. Where would you like to see them really prioritize some of those dollars?
Well, I guess there's a couple ways to answer that. I think what the push into live sports is really about capturing, I think, advertisers' attention. Advertisers love advertising on live sports more than they do most other content. So that's why I think they probably reluctantly went down the live sports path. In other words, it's not a coincidence that Netflix launched its ad tier. after saying it wouldn't for a decade plus, and then very quickly followed up with launching live sports. Those two are joined at the hip. In terms of where they should spend their money, the way I sort of think about it is for Netflix to distance itself further from competitors. The North Star is not really whether it's scripted or unscripted or sports or non-sports. The North Star for Netflix is how can they crack the code on spending $1 of content and having that content resonate globally. Right now, they're a little bit stuck where they're spending money to gain consumers and viewership in a particular country, but most of those shows are not traveling around the world. And there's good reasons for that. There's just cultural differences in each one of the countries that the Netflix competes in. It's an issue that every traditional media company has faced.
Jason, great to have you on here with us today, and thanks so much for, of course, always, we know, keeping tabs on Netflix, but coming on to discuss it with us. Appreciate it.
Absolutely. Happy to do it.
Jason Bazinet, who's managing director over at Citi. Well, investors are looking to the tech sector for signs of life this morning here as tech stocks are extending some losses after the NASDAQ composite logged its worst day in the last 2 years. This week, chip stocks like Nvidia, TSMC, and ASML were hammered amid a rotation from tech leaders into less prominent parts of the market. So, with a bit of a sell-off on the top of minds of investors, how should you play into the sector? Here with me now, we've got Tony Zaparo, who is the Equity Set CEO. Great to have you here in studio back with us.
Thank you for having me.
Absolutely. All right, so let's dive into this. I mean, what do you make of some of the rotation or profit-taking that we're seeing this week? Is it just trimming of positions and reallocating elsewhere? And if so, where?
I think what you're seeing with the volatility, right, the semis and what's been working going down, I think it's been long overdue. As we know, momentum kind of leads the market. And so really the narrative should be where you think we are in the economy. I think we might be closer to an early to late stage peak, right? Not necessarily going into a huge contraction, but with a little bit of slowdown, if you are of the same mind, that's where then you definitely trim down on some of the more discretionary, capital intensive industries and technologies, such as the semis, right? The ones that have really gone up leaps and bounds, and you get a little bit more defensive in terms of technology industries to play.
And thinking through where we are in the economy and using that as perhaps the North Star or one of the guiding principles here, then you'd also have to think about what areas of the market are most impacted or most sensitive to the rate environment. What are those for you?
Absolutely, and that's capital intensive industries, right, where you've got not the greatest, where they're trying to get to profitability, right? You've got a lot of debt on the books. You really have to be cautious. Not saying that they can't continue to grow, right? Because the kind of antithesis of that is we're in the middle of a multi-year expansion boom, and we're just taking a little pause here. But you're exactly right in you want to look for stickiness. Enterprise spending, I mean, not maybe on a day like today for something like CrowdStrike, but cybersecurity, right, is another one. So healthcare tech, information tech, and getting back to software application infrastructure, the things that will be stickier or money will continue to be put into an infrastructure or healthcare.
We haven't gotten into the teeth of big tech earnings yet, but as we're really anticipating the next few weeks and the results that are going to be coming out, what do you believe is going to be the barometer for this earnings season?
I think it's going to be how good the growth outlook is. And if it falls, and I can't put my finger on exactly what that expectation is, but even if it's growth, but it's weaker than expected guidance, I don't think it's going to land well. And so that's where those big tech earnings could continue to perform well, right? So you've got Microsoft, you've got Adobe, you've got, again, those players that could be more defensive, but because they've been pumped up so much in terms of price, that's where I'm a little wary until that clarity comes. And so I think it's going to be, and if all of a sudden the guidance is bad, right, it signals a decline, I think there's going to be a lot of blood in the streets in those names.
Just lastly, Nvidia has continued to be quarter after quarter one of the companies that can either make or break an earnings season. And so I want to get both sides of that. What is a company that could make this earnings season? What's a company that could break this earnings season?
Nvidia, absolutely. And I think a lot of people are looking to that. If they surprise on the growth side, right, and it continues to be strong, it's going to carry all those names up. And the contraction or the correction you've seen here, I think it's going to continue its momentum up. And so I think it's still Nvidia, right? I think there's a couple others, right? If you look at the Mag 7, right? Look at Amazon, look at Microsoft, look what they're leading and guiding to. But I think there's an oversensitivity to, is it 15% growth? Is it 10% growth? Is it 2% decline? What does that look like?
Absolutely. Tony, great to see you back here in studio with us. Thanks so much for taking the time. Tony Zaparo, who is the Equity Set CEO. Well, are you in the market for a new home? We break down everything that you need to know before you hit the open houses this weekend. That's right after the break. With housing costs continuing to remain high, the question of whether to rent or buy is a big decision many Americans are facing. So what are some factors that you should consider before beginning your housing search? Yahoo Finance contributor Ross Mack live here in living color with us with more. Hey, Ross.
Hey, man. So look, I think I like the question, but I think everyone has to understand there is no clear-cut answer, right? At the end of the day, you know, you might hear some people say, well, actually, you should buy because that's an investment. And other people will say, well, if you're renting, you're actually wasting money because what are you doing? You're just paying your landlord's mortgage. But at the end of the day, I think you have to look at it situationally and understand where you are, right? And so when it comes to buying, you have to understand a few things, right? One, you want to know that you have great financial stability. You want to have a good job, a good stable paying job, but also you want to have a lot of cash in reserves because there are a lot of costs that you might not actually expect, right? Especially when it comes to maintenance, who's gonna, you can't call your landlord when that hot water heater goes or your roof needs fixing, right? Or a furnace goes out. So there's a few things. And so when it's all said and done, obviously you're gonna have HOA fees potentially, PMI, right, insurance costs. And so when it's all said and done, when it comes to buying, your mortgage is the minimum that you'll pay. There's so many other variable costs. And when it comes to renting, right, your rent is actually the max you'll pay. And so when it comes to kind of the science, right, I think we talk about budgeting from a 50-30-20 standpoint. When it comes to your mortgage, I want you to look at this as saying you don't want to pay no more than 28% of your monthly income when it comes to your total mortgage standpoint.
So what are some advantages and disadvantages of renting then on the other side?
Yeah, some of the advantages of renting, right, is flexibility, right? The ability to say, hey, maybe I want to move somewhere in a year. We'll call it a year, right? Some people could actually pay month to month, but just call it on average, you are signing a lease for about a year or so. So one, you got flexibility. Two, you also have the ability to, actually live in different places, and actually maybe you want to live on the water, your job isn't as stable, but I think the biggest disadvantage is you're not actually building up that equity, right? I think as a homeowner, you have the ability to be building up equity, you have the ability to have tax advantages. So there are a few things, but I think when it's all said and done, in the short term, you can look and say potentially renting can be better from a flexibility standpoint. You don't necessarily have all your I's dotted in the unit effectively. Buying in the long term should be better.
Ross Mack, thanks so much for joining us here in studio. Make sure to check out Financial Freestyle. That's every Monday here on Yahoo Finance with Ross Mack. Well, mortgage rates, we're continuing to track this. Mortgage rates falling to the lowest level since mid-March. The 30-year fixed rate falling to 6.77%. But what other costs should home buyers be aware of here? To discuss some of the hidden fees that you need to watch for if you're in the market, we've got Sean Grisbin, who is the Chase Home Lending Head of Consumer Originations, joining us. Sean, first and foremost, a lot of people, as we were talking about in our last discussion, they'll think about some of those upfront costs. And one of the main upfront costs that people think a lot about is just the down payment. But what are some of the other, perhaps, top 3, maybe even top 4 expenses and fees that people should be readying their mindset for?
Well, thanks for having me first, Brad. And I totally agree with Ross on some of his insight around renting versus buying. But as it relates to the cost of homeownership, obviously you have the down payment, you have your interest rate, which I think most customers really tend to focus on in the process. And the area they spend less time on, frankly, are the fees that go along with not only the interest rate, but also the cost of buying the home. So those closing costs are disclosed actually on a government document that makes it actually pretty easy to compare as long as you shop with more than one mortgage lender.
And so with that in mind, we've continued to watch, and that's kind of the week over week that people are continuing to see moderate lower here. And especially as we're looking at it below right now, that 4-week average and even the 52-week average. What do you think that this will initiate in this near term as people are trying to time their entry into the home buying market and where they're throwing bids in?
Yeah, so right now about 70% of the mortgage debt outstanding is less than 4%. So even though rates have come down slightly, they're still relatively high considering what most customers have dealt with the last few years. I think what we are starting to see is some of the lock-in effect, which is really customers not willing to list their home because they have such a low rate. Now that rates have been high for some period of time, we're starting to see a little easing. I think customers are becoming more comfortable listing, and we're actually seeing inventories grow for the first time in several years.
And so with inventories growing, does that mean that we'll see some of the bidding spread out, or is this going to be more concentrated as it's continued to be? Because for kind of coming into these past few weeks, we had seen some of the homes that are still getting multiple bids, the period that they would be on the market was lengthening just a little bit as well.
Yeah, and honestly, we're seeing a lot of that. We're seeing price reductions for the first time in a while. We're seeing less of those price wars on individual homes, but it is different based on where you live and the competitiveness of the individual environment there. But I think generally speaking, we're seeing prices, they're still growing, but starting to grow at a slower rate, which again, I think is advantageous for future home buyers for sure.
One huge word in the home buying market, especially when you're going to get approved, worthiness. So how can people and potential homeowners, prospective homeowners, improve their worthiness for that loan in order to get them into the bidding wars and really outlast the bidding wars for that dream house?
Well, at Chase, we really think the best thing to do is go to your bank and see your home lending advisor, because from there, you can get a lot of expert advice for free. They'll help guide you along the process, and they'll also educate you on the things you need to know, because mainly it's all about employment and reserves, as Ross mentioned, as well as your ability to maintain the mortgage payment through time. And so all of that can be figured out by simply sitting down with a home lending advisor or really any mortgage company and talking through exactly what you need to qualify and where you stand today.
You know, and just one other thing within this sub-question, because I saw being an advocate for your own financial health and literacy, how do I show up as an advocate for self when I'm going into these conversations, whether that be with a financial institution and trying to get a loan, or whether I'm going into those negotiations? I mean, so many different parts and some complex conversations that people, if they don't have representation, that they might have to navigate themselves. So how can they advocate for themselves?
The main thing to do really, as it relates to your mortgage, is to actually shop. You know, we find, studies have shown 54% of customers don't shop. The 46% that do actually get a better deal. And so it's never good to just go to one lender, first off. Second off is, again, find someone that you trust, find people that you know have bought before. You know, again, at Chase, we have home lending advisors in branches across the United States, happy to help anybody at any point in time. But really, there are advocates available. Your realtor can be very helpful as well in the process. But I really encourage customers mostly to represent themselves in this and take the time to shop. It's become easier. As I mentioned earlier, there's a standardized document that allows you to compare costs, rates, everything you need, including payments. And it's just most important to not be in a hurry, to not be intimidated by the process, which many customers are, and to actually explore your choices.
Sean Grisbin, who is the Chase Home Lending Head of Consumer Originations. Sean, thanks so much for taking the time here with us today.
Thank you too, Brad. Appreciate it.
Definitely. Small caps rallying this week. We explain what the stocks are and why they spiked this week. That's right after the break. More bad news for student loan borrowers. A federal appeals court has blocked President Biden's debt relief program, which is known as SAVE, intended to lower monthly payments and calculates what you owe based on your income and family size. Now, the decision comes after back and forth rulings last month, which blocked parts of the SAVE plan and then allowed the Education Department to proceed with parts of the plan. Here with more, we've got Yahoo Finance's senior columnist, Rick Newman. Okay, so a lot of going back and forth on this, it seems, to this point, Rick.
It was on, it was off, it was on, now it's off again. So this is not the final word, and this is not the only debt cancellation plan that Biden has. It's a big one, though. It's the SAVE plan. It has more than 8 million people who can qualify for it. And this is one that would lower payments for people who have been paying for a while. So you get credit if you've been paying for more than 10 years. And there's no way to just explain to people, here's what to do. You have to, you just have to know which plan you qualify for. There's a website, studentaid.gov. Every time we talk about this, I'm like, you're just going to have to go and find out what's going on. Yeah. And what the government is now doing. So this litigation is going to continue. The whole question is whether, because Biden did this by executive authority in 2023, a lot of people, including Biden himself, have expressed doubt that the president actually has the authority to do this, to cancel student loans without an act of Congress, without it actually being written into law. So Biden tried to do it. And as I think everybody expected, just about everything he has tried to do has been challenged in court. So the cancellation under the SAVE program, this is not final. The appeals court has said we're going to put this on hold, so there's going to be no debt cancellation until it works its way all the way through litigation. So in the meanwhile, the Education Department says, well, you're going to be in an interest-free program, so you may pay back the principal. In the meanwhile, we're not going to charge you interest until we see how this shakes out. There are other debt relief plans, so some other people are not affected by this. You just need to know which plan you're in and follow the website to see what the latest developments are.
How much does this become one of the talking points going into November? The amount of loans that are looking to either be just forgiven in entirety or at least trimmed down?
Biden wants it to be a talking point, assuming Joe Biden is still a candidate, which seems increasingly unlikely. But even if he's not, I think this is popular among basically all Democrats, at least some degree of debt cancellation. So Biden's point on this, going all the way back to when he was campaigning in 2020, is you need to do this through congressional legislation. So what the Democrats say is you need to elect a Democrat to president, and you need to give Democrats control of the House and the Senate. And that way, maybe we can write this into legislation, and then the legal challenges won't be so severe. However, as a reminder, Democrats had control of both houses of Congress for the first 2 years of Biden's presidency, and they could not get this done. If you're going to, this is a lot of money when you tally it all up. And if you're going to take $100 billion and say we want to create an aid program, the first place to target it would not necessarily be college graduates. There are needier people than college graduates if you're going to dole out federal aid. So that is one of the reasons this is hard to pass, even among Democrats. But that's what Biden wants people to think anyway. Donald Trump, for his part, this is not something he talks about. He doesn't like that cancellation. Republicans in general don't.
Yeah. All right. Rick, thanks so much for keeping tabs on this. Appreciate it. Well, small caps have been on a tear this week, up nearly 2% as investors rotate out of the big tech names and move into small cap stocks. To discuss, we've got Yahoo Finance's very own Julie Hyman here with us in studio. Hey, Julie.
Hi, Brad. Yes, we have seen a big gain in small caps. And just to back up for a second, to sort of set the table on what we're talking about, small cap stocks generally have a market valuation of between $250 million and $2 billion. Mid caps, so when you hear those mentioned in conversation, $2 to $10 billion, and large caps tend to be $10 billion to $200 billion, and up from there, of course, because we have some multi-trillion-dollar valuations now when we talk about the mega caps. So that's what we're talking about in general when we're talking about the small caps. And if you look at how these have done, and this is the returns from when we got the CPI report through yesterday, this explains a little bit the timing that is as to why these stocks have done so well. And what you're looking at here is the Russell 2000, which is small caps, versus the S&P Equal Weight Index and the S&P 500. The Equal Weight Index just shows as if every stock had an equal weighting. The S&P 500 is market cap weighted. So this shows that there has been pretty broad participation, but that the small caps have been the winners. So what changed with that CPI report? It was another report that showed inflation is moderating and raised those expectations that the Federal Reserve is going to cut rates come September. Why is that benefiting small caps more than the others? Well, small caps have underperformed this year. They also tend to carry more debt. So the perception is that when rates start to come down, that it will be more beneficial to those companies. That's just one of the reasons why we've seen them do well. So this is through yesterday. We have started to see this rally, though, and the rotation start to roll over a little bit, and that continues today. We've got the Russell 2000 down about 0.5% in today's session. If you look at the full week here, you'll see the peak and then a little bit of a come down. And if you look at that in contrast with those two other indices we were just looking at, the S&P Equal Weight has done the same thing, but it's underperformed the small caps, and so has the S&P 500. In other words, the small caps have started to now come down, but it's still outperforming on the week and on the 2-week period these other bigger cap stocks that we have been watching, which has been interesting.
And so is everyone on the small cap bandwagon? I mean, how many are perhaps saying, yeah, small caps, here we go from here?
Yeah,
or are there skeptics out there?
Yeah, there are definitely skeptics out there, right? There are definitely skeptics out there who are not all in on this. We talked to Ed Yardeni of Yardeni Research the other day, and he said there's short covering that is happening. So part of this is a short squeeze, which implies that it's perhaps not as sustainable. One of the other skeptics out there is Eric Johnston over at Cantor Fitzgerald. And among other things, he is looking at the profit forecast for these small cap companies. As Savita Subramanian over at Bank of America points out, about a third of the companies in that Russell 2000 index don't make money. They're unprofitable. But looking at it another way, as Johnston does, here's the profit margins on a historical basis. And so you see the trajectory is kind of downward. And as he points out, this is the 10-year average profit margin. And we're kind of bumping right around there. In other words, we're not seeing above average profitability for these companies at a time when people are pouring in. Johnston also points out that the valuations are relatively high given this kind of profit profile. Finally, to go back to Subramanian from Bank of America, while she pointed out the weakness in some of the small caps, she's still a buyer of certain subsectors, and she talks about buying higher quality small caps. So in other words, even for people who are looking at small caps, they're not necessarily looking at the complex as a whole. They're taking another look, but then using other filters to figure out what to buy.
All right, keeping the pulse on small caps for us here, Julie Hyman. Julie, thanks so much. We've got much more on wealth after the break. You're watching Yahoo Finance. Americans are worried about their job security despite continued historically low unemployment. According to a new study from MarketWatch, a full 70% of employees are bracing for layoffs in some way, whether that means saving money or applying for other jobs. To help us dive into this study, we welcome in Matt Brennan, who is the MarketWatch Guides data journalist. Great to have you here with us. So, just take us into some of these findings. 7 in 10 workers bracing for job cuts here.
That's right. Thank you for having me on. So we wanted to learn more about how people are reacting to news of potential layoffs. We know that in 2023 and in 2024, there were a lot of headlines about layoffs, especially at tech companies, giving people a lot of concern. So what we wanted to do is we decided to survey 1,000 American workers, excluding those who are self-employed, because you can't lay yourself off, to find out how worried they are about being laid off. So we asked about job security, opinions on if they're taking preparations to get ready for layoffs, financial readiness, and how far they'd be willing to go to keep their job. And as you mentioned, 70% of the people we surveyed said they're bracing for layoffs in some way. That means different things to different people. 40% of those are people who say they're saving more of their income than usual. 32% say they're actively browsing job listings. And 24% say they're actually applying to new jobs right now. Those numbers are even higher among younger workers who are especially nervous. It makes sense, given that Gen Z workers would be a little more anxious. They have less seniority, and they're particularly worried about being laid off.
With that in mind, and kind of continuing down that thread, I'm wondering where it continues to kind of break up, where there's some divergences even among generations that are actively in the workforce right now.
Yeah, absolutely. There are big differences, and one of the big ones is that age gap. So we found that baby boomers feel more secure in their jobs. It makes sense. They've worked for decades, building up their seniority, whereas Gen Z workers, 88% are taking steps to prevent a job loss, trying to preempt it in some sort of way. Layoff anxiety is a term that we asked about to find out just how concerned people are. And a majority of Gen Z workers and nearly half of millennials are anxious about being laid off. So we've definitely found that the younger you are, the more likely you are concerned about this. And that also matters because younger generations are particularly fearful of AI coming to take their jobs. That was another one of our big takeaways.
It's really interesting. For those who are concerned with AI potentially taking their jobs and then hearing that, hey, maybe there's a way that I could work with AI to be more productive and maybe even getting to a point where just give me the AI so I can be more productive and keep my job. How are you seeing people potentially reskill or upskill even in order to add on to their own job security or at least best position themselves to be more productive in their current role?
Well, one of these aspects, it's a little bit tough to get ahead of the curve if you're already deep into your career. One of the things I would mention is that it's going to depend on what field you're in. So there was an MIT study that looked at what they called vision-related tasks, which are jobs they deemed a little easier to study in terms of how likely it is for AI to replace them. And they found that jobs like retail, social services are at higher risk than roles pertaining to education and finances. So one thing I would say is it's going to depend on your job field, how nervous you are about being laid off. And the researcher who wrote that paper, we spoke to him, who said that these things are going to start to happen as soon as companies feel they can upscale their AI enough to where it can replace people. And we did recently see Intuit lay off about 10% of its workforce, citing AI as one of the reasons there.
I know you have some tips as well for dealing with layoffs because, it's never something that anyone wants to have to experience within their career. Many of us do at one point or another, and it's never easy. But, some of those tips might be very helpful for folks right now as well. I hope it doesn't happen, but in the event that it does.
Absolutely. As part of this project, we talked to a lot of experts about what to do if you are fearful that you will be laid off or that you have just been laid off. The first step, if you're facing a layoff, is just to seek support. You don't want to get wrapped up in the financial and turmoil you might be feeling internally. It's much better to just take a breath and try to talk to people you trust. From then, if you are laid off, there are resources out there for people who have recently been laid off. You can talk to the Career Center at maybe your alma mater, or there are local American Job Centers, which are funded by the Department of Labor, which provide interview training, help with people organizing their resume, that sort of thing. I would also add, once you're in that sort of position, it's important not to focus too much on the fact that you're in a state of uncertainty. It's still important to find time to do the things you like to do, just to try to take your heart rate down and remember that there are other things in life aside from maintaining your job.
Certainly. And I'll add one on, Matt. Preempt it. I mean, just go to your boss and off cycle, just say, hey, I want to know what I can do better. Where do you think I can help this team more? Sometimes that goes a long way too, and just showing initiative. So Matt, thanks so much for taking the time here on the day. Matt Brannon, who's the Market Watch Guides data journalist. Appreciate it.
Thank you for having me.
Certainly. The IRS is changing rules for pulling money out of your retirement accounts early. We discuss what you need to know right after the break. Stick with us. Need a quick $1,000? The Internal Revenue Service, aka the IRS, making it easier to take some cash from your traditional retirement account, penalty-free, for a personal emergency. To discuss what this means for your money, we've got Bill Harris, who's the Evergreen founding CEO. Great to have you here with us. First and foremost, I mean, just take us into this update from the IRS. This is pretty significant.
Yes, it is, Brad. Great to be here. And this is another of the steps that the IRS is taking in recent years to be a little bit more customer-centric. Some of the things they're doing, they're offering some free tax software for very simple returns. They're trying to do a better job answering the phones. And in this case, what they're doing is allowing people an easier way to take up to $1,000 out of their a retirement account if they need it for a personal emergency.
Okay, and so with this now, I mean, what really prompted this? Was it pressure on the IRS? Was the IRS realizing that more people needed to be able to tap this for just emergencies? Well,
it's pretty common knowledge. In the economy right now, there are many people who are struggling to handle emergencies, particularly because they have not much cash on hand. Right. And currently, you can, in a hardship or an emergency, you can withdraw money from a retirement account without paying the 10% penalty that you would normally pay, as well as the tax bill that you would normally pay if you take money out. There are exceptions today, but they require you to specify the exceptions and work directly with your employer. This $1,000 amount is now free from an employer's certification.
Does everybody qualify for it, or are there certain prerequisites?
Just about anybody who has a retirement account, either a 401k or an IRA, can take out this money. It can only be done once a year. Not all employers actually support the plan at this time, and you can only take any amount that is over a minimum $1,000 balance in your account.
And does it sound like there are taxes that you would have to at least consider around this type of withdrawal?
Yes. When you take money out of a retirement account, a pre-tax retirement account, you owe taxes. And so you would typically, if you just withdrew the money without a hardship or emergency exemption, you would typically not only owe the taxes that you never paid originally on that amount that's been invested, but also a 10% penalty. Now, in this case, if you take the $1,000 out, you don't have the the 10% penalty, but you do ultimately need to pay the tax on that $1,000 if you don't pay it back within 3 years.
Understood. And Bill, just lastly, while we have you here, I mean, one of the major things that we're kind of trying to track right now is just the state of retirement savings. I mean, if you're taking away from this 1,000, of course, that's, or taking out this 1,000, of course, that's 1,000 less that you have for later on. But maybe that helps you out in the long term because you're also not hitting your real cash or the real kind of cash flow that you may have to deploy towards that expense.
No, it's very tempting to take the money out, and that's exactly why you should work very hard not to do so. This is your long-term money. This is your retirement money. This is what you're funding for the future, and it's actually a good thing that it's hard to take money out of a retirement plan. Mm-hmm. So although you don't have to specify the reason, work really hard to use this only when you absolutely need it. And by the way, the money that you talk about could be in a bank account. Well, in bank accounts today, you're earning just about nothing. All of the majors, Wells Fargo, Chase, Bank of America, you know what they pay on checking accounts and savings accounts? 0.01%.
Wow.
And by the way, if in the current 5% interest rate environment, if all checking accounts, just the checking accounts, paid 5%, the American public would earn an additional $283 million each day in their checking accounts. People lose as much money in interest in their checking accounts as they are paying in interest on their credit cards.
That's really interesting, especially given the amount of fees that we've started to get charged on some of the simple savings accounts right now. That's a conversation for a different day. Bill Harris, Evergreen founding CEO, joining us today. Bill, great to see you.
Thanks a lot.
Thank you. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. So you can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You do not want to miss it.